Right, we're live. Right, thank you folks for this meeting this afternoon, Finance and Corporate, here on the Wednesday the 25th of March. We have a very full agenda with some fantastic presentations also from different stakeholders throughout Waikato. So looking forward to this meeting. I guess we have got a full agenda finishing just before 4 o'clock. So just to be, I guess, cognizant of the time, what I will do is probably run a couple of mini breaks, a couple of 2 to 3 minute mini breaks, and I'll try and time them around the sort of hour-ish or time around speakers. All right, so we do have an apology from Councillor Kempson, who is away for personal business. And we have a potential early departure from Councillor Gower and Councillor Gordon. So you're happy, you two, that we just move those together? All right. All right, so those apologies, Claire and Dale Marie moved. All those in favour? Against, carried. Thank you for that, folks. Disclosure of members' interest on page 5. Are there any? No, there have been none. Late items, none have come this way. There is none. Thank you. Confirmation of the order of business. Everything's going to stay the same as far as I'm aware. All right, so we need to move in a seconder for that. Thank you, Marcus, and thank you, Dean, if I got that right. All those in favour? Against, carried. And confirmation of the minutes for December the 10th, which is on pages 8 to 10. All right, any comments there? No, happy to move, Claire. Happy to move, Roger. All those in favour? Against, carried. And now into our first substantive item. Okay, and the presenter is Amy Turner, but we also have, I think, Earl White and James Graham. So I invite you folks up. All right, so Amy's not here. No, right, fine. So look, welcome Earl from Bancorp, Treasury New Zealand, and welcome, of course, James, who's our financial officer. And we have a very thorough report here, though that you will talk to at least. I'm starting on page 13.
Yeah. Just thank you very much, Mayor. I'm just quickly introducing this report because obviously Earl's here and we want to maximise his time. It is a nice lead into the 8-month reforecast that will follow. This is something councillors have asked for a while for Earl to come. So I'll hand over to Earl. Thank you very much.
Thank you, everybody. And if you haven't met me before, my name's Earl White. I'm a director of Bancorp Treasury and I've been involved with Waipara Council for many years, and it's a very enjoyable role that I take, and I enjoy coming down here to talk to you guys. So I think we've got time for questions at the end. So I'm not going to do an absolute page flip, but this is sort of some background to give you some ideas. And the first thing we obviously talk about is oil prices, right? You know, I mean, if this was February the 25th, my presentation will probably be quite different. I might have highlighted some of the potential issues of this, but, you know, things have changed completely. So there's the oil price over the last 12 months. As you can see, pretty stable. Everybody got pretty comfortable with oil being in a bit of a range and actually relatively weak, and that all got blown out of the water, literally. And to give you a sense of perspective, it's a big deal even over 10 years. So that's the move that we've seen, which it's come back down to sort of $100. But so the move was bigger than we saw after the Ukraine war. And the Ukraine war was interesting because you remember Europe had huge dependency on Russia for gas prices. So there was a major problem in Europe around high gas prices because of the conflict. But this move in oil has been more pronounced than the Ukraine impact. So, you know, this is something quite serious. The good thing is that hopefully it's going to be resolved within 4 years, unlike Ukraine. So, you know, this is weeks, not years, hopefully, and that's our core view. But certainly, this has been a big deal, and it's certainly overwhelmed all the other stuff we're seeing currently. But we don't want to lose sight of the fact that there were issues before this happened. So in the US, they're losing jobs. So the latest non-farm payrolls data in the US showed about 100,000 jobs lost. Those orange lines are monthly payroll updates. And as you can see, since about late 2024, it's been a pretty mixed picture. So in general terms, the US employment markets, the US economy has been slowing. So that's before this conflict, right? And we look at China, our biggest trade partner, and very important for us. This is a graph of investment growth, property investment growth in China. So since 2022, there's been 2 months where investment growth into property in China actually was positive. Now, the Chinese economy for about 10 or 15 years was driven by a booming property market. So China was slowing anyway. And here's Chinese house prices, same picture. Chinese house prices have been falling for a good 6 years. Most commentators think there's still about 40 or 50 million worth of excess apartments in China. Probably another 3 or 4 years to sort out the issue, at least. So what China's been doing is pumping up the exports. So what tariffs? China doesn't care about tariffs, right? China is exporting to the rest of the world, and it's exporting a lot. So in January and February, they had a $213.6 billion US, this is real dollars, not the New Zealand peso, $213.6 billion trade surplus, 21.8% higher than the year before. What tariffs? What impact? So China has been exporting its way out of trouble because its domestic economy is in big trouble because of a housing price crisis, right? A huge slump in house prices because they had an unmitigated disastrous boom. So China is going to do whatever it can to keep its export engine going, which is good news for imported inflation for countries like us because products they make, they're going to continue to supply cheaply. If you would have thought there's a lot of demand for EV cars in the last 2 weeks, surprise, and you think the Chinese will be pumping the price up, they will pump the volume up because they've got, they want it. So that's a bright spot for potential inflationary issues around this oil price, right? And also China doesn't want the oil price to stay up for too long because its domestic economy is weak already, and it wants the people to be buying its exports. So China doesn't want world growth to fall, right? It's the second biggest economy in the world. So China's on our side when it comes to getting this thing resolved quite quickly. They don't care about Ukraine, but they care about the Middle East because unlike Ukraine, which only affected Europe really, and Europe turned pretty quickly away from gas from Russia to other sources, oil affects the whole world. So that's why we're pretty positive this thing will be resolved relatively quickly. It's going to be painful, but it's certainly not going to be as serious as Ukraine was on Europe. That was a year or two sort of drag. China's inflation starting to get above zero, which is good for them. So they're probably pretty happy about that. But deep down, what they're looking for is to keep their export engine going. Now, our good friends across the ditch. So with China and Australia, that's basically our 2 biggest trading partners. Australia has got an inflation problem. Had an inflation problem before this started. It's got a bigger inflation problem now. The problem with Australia is that it's where we were 2 years ago. It's got dreadful, well, like us for the last 15 or 20 years, it's got dreadful productivity growth and a housing boom. Our prices have come down. So Aussies having to put up interest rates. Look at the US, interest rates in the US are pretty constant. Aussie rates have gone up a lot. It's all about this. The housing market. So there's the Aussie house price index from a week ago. There's been no correction. In fact, the increase of house prices during COVID was kind of a blip. Went up a little bit, but it's really got a head of steam now. So New Zealand had some issues anyway because China, our biggest trade partner, has got a domestic economy which is very weak. Luckily, we sell milk and protein, which they're still buying. But if you look back there, the biggest export out of Australia is iron ore. That's iron ore or coal are over 60% of Australian exports, right? Look at the iron ore price. Sorry, I don't know why those numbers have gone are silly, but that's over 5 years, I think. So for the last 2 years, the iron ore price is basically that KIJ, whatever it is, that's $100. So iron ore has been flat for about 18 months now, and it went up a couple of bucks a tonne. It went from 98 bucks a tonne to 100 bucks a tonne when this kicked off, and it's maybe 102 bucks a tonne now. So there's been no increase in the iron ore price because of the Gulf War. This is because the Chinese central buying outfit controls 60% of all iron ore sales into China. So they've decided the price is 100 bucks, that's what it is. So Australia's not getting an export boom that we're getting. We're getting a massive export boom here. Dairy prices are at record highs, meat prices are doing well. Our export sector is doing spectacularly well. Unfortunately, it's a small part of the economy. But Australia has got an issue. And as I said, this is the issue. That's going to pop at some stage. It has to. That's driven by high levels of immigration, 300,000 people a year, a huge increase in the public sector. I think about 80% of jobs being created in Australia at the moment are at either state government or central government level. We saw that in Wellington. What happens is productivity falls. You get more public sector workers with the best will in the world. It means that productivity and GDP per capita declines, right? So Australia's got the same issue. So our two biggest trading partners were a risk for us before we even had this oil crisis. So, we don't need to get, I don't think New Zealand needs to get too concerned about the oil crisis. We had some concerns anyway. So, good news, Earl. I try to be positive, but it's pretty hard at the moment. So the domestic economy, well, the good thing here is that while financial markets are all getting a bit carried away and they're implying quite significant price increases. So the Reserve Bank in February said they'd see the cash rate maybe 2.75 or 3 by mid-2027. The market's now saying, the cash rate's going to be, 3.75 or 4 by late next year. We see that as a very unlikely outcome. In fact, we see it as a ridiculous outcome because the New Zealand economy is weak. We only grew by 0.2% in the fourth quarter of last year. This is before the oil crisis. So what's happened to business and consumer confidence over the last month or two? We've got an election coming up at the end of the year, which looks like a coin toss. The policies coming out are sort of like, who knows what's going to be happening and what are people going to be talking about? So if I'm sitting there in a business going, am I going to hire 5 new staff or build a new factory? I'm going, maybe I'll wait till November or December, or I might just tick over. Do the good old New Zealand thing and go, we'll hire a few staff, pay them some wages. I'm not going to spend $1 million on a new machine and all that kind of stuff. So we're in that sort of malaise at the moment. So it's going to be pretty hard for the Reserve Bank to aggressively put up interest rates when the economy was only just starting to recover and is going backwards. Now, the good news for Waipā is that this is Auckland, this is Wellington, this is the cities, right? The service sector and the farming support sectors are doing pretty well. Property's going to be flat at best, prices might stabilise, but low immigration means, we've still got problems with that, but good developers with reasonable debt will still be doing stuff. Good friend of mine does developments in Cambridge and, they're still doing stuff. They're just slowing down a bit, but it's not a concern for them. They can push the pipeline out a bit. People who paid at the top and are developing stuff that's too expensive, they got problems. So there's a bit of that to go yet. But we don't see a massive change in interest rates in New Zealand because of this crisis. We think New Zealand needs relatively low interest rates compared to history to just keep ticking over. And here we look at interest rates. So the gap between the cash rate, which is the red line, and all those other lines are the term rate. So now, if the council said, look, we want some certainty, so we'll go and borrow for 5 years. Well, we can borrow for 5 years off the local government funding agency at, 4.8%. Or we can borrow off them for 3 months at 2.8. I know what I'd rather be doing at the moment. I mean, we've got to have a level of certainty, but we've also got to be sensible about what we do. Our strategy for quite a while had been looking for lower interest rates and then locking in. It was all going along swimmingly until, this happened. So you've got to then reassess and be sensible. Don't just blindly follow your strategy because the strategy inputs have changed. So our view is Waipā's in a good space. Your interest rate exposure and policy stuff is at the back end. We do the minimum we have to at these high rates. We certainly don't want to be panicking and locking in these borrowing levels at the moment because things will change. All I know about being in markets for 30 years is they always do what most people don't expect. Because if they did what everybody expected, everybody would be a millionaire, wouldn't they? Because they know what's going on. So markets, all markets ever do is surprise you. When you think you know what a market's doing, you've got a problem. And if I came here and told you I know exactly what's happening, I'm lying because I don't. We can have a view and we can have an opinion, but nobody knows. It's the future. We can have a intelligent discussion around what we should be doing within the strategy framework and plan accordingly. And that's what we're saying now. We've modified our plan a little bit in reaction to these exceptional moves, which we believe will wash through the system. Because ultimately, we think the New Zealand economy is not set to boom anytime soon because of those fundamental issues I've highlighted earlier. This is not, we weren't heading for 3 or 4% growth and a boom before this happened. We were coming out of a recession and we were going to slowly drag along. Because the big problem is our export sectors, which are doing so well, are only 25% of GDP. Now, to put that in perspective, in 1964, guess what exports were as a percentage of GDP? Round about 25%. So in the last 60 years, the level of export activity in New Zealand, which is an export nation at the bottom of the world, we're the world's best exporters of things, aren't we? We haven't grown our exports as part of our economy by any percentage at all. Because guess what we've done? We've all played this game. We've done this. Let's get into houses, guys, because look what happens. House prices go through the roof. You can buy a house and COVID was a bit of an issue, but that was going to correct. But we've had now 3 years of flat house prices, right? Is that a fundamental change? I hope so, because New Zealand needs a lot of this to actually start to invest in things that make money for us as a country. But last year, bank lending grew by 26 billion. 80% of that was to housing. Pretty hard for your export sector to grow when 8 in every $10 that the bank lends is for somebody to buy a bigger house off somebody or whatever. So we're all wealthy in New Zealand if you own a house. Well, we're not really, because the New Zealand dollar's gone from 70 cents in the dollar to 55. So try and sell your house, try and sell your really expensive house in Te Awamutu and buy a house in Sydney, So, the currency's telling us a story. Fitch came out last week and said that we're on negative credit watch, right? We've got some fundamental structural issues in this country. We've got far too much debt. We've got absolutely appalling productivity. And we've got an export sector which is battling to actually grow at all as a percentage of the cake. And that's the sector that pays the bills for us to have hospitals and all this kind of wonderful stuff. Buying and selling houses off each other doesn't build hospitals. It doesn't make current account surpluses. It doesn't make us a wealthy country. We can tax whoever we like, but you've got to actually be doing things. And people talk about the Scandinavian situation. They've got a socialist type system. Everybody's looked after. They're wealthy countries. Yeah, but Norway's $1 trillion of export receipts from oil. It's easy to be sort of, oh, we're wonderful. You've got $1 trillion worth of oil, guys, for 5 million people. If New Zealand had $1 trillion of investments from oil, we'd be pretty good as well. Denmark and Sweden, massive exporters. IKEA, massive global export companies. We've got Fonterra, which has sold half their ingredients, which may be good or bad in 30 years' time, who knows? Seems okay at this time. But how many global brands have we got? In the 80s and 90s, New Zealand was looking to grow lots of stuff, right? We were pretty dynamic. We seem to have, I'm too old now. It's not going to change. I'm not going to have to change it, but this is a worry for us. So what I'm trying to say is things are going to be tough anyway. Don't have a heart attack about the golf. If you weren't worried before, maybe you're missing a few points. So from the council's point of view, wage growth is very low. So we had that big spike during COVID because of, in Wellington, the government was paying $30,000 a year over the odds for a mid-level accountant. So guess what the private sector had to do? Had to match them. So you had this typically you've had, the public sector's wages have been lower than the private sector, right? And then the public sector are trying to catch up. Well, during COVID, the public sector passed. So now we've had that reverse. So it's going to be hard for wages for a while. So again, companies can't afford to put wages up. So is the Reserve Bank going to have to put up interest rates massively? Probably not, because people's budgets are going to get squeezed. If you're paying $50 a week more for fuel, that's $50 less you can spend on something else. In general terms, higher energy prices are a tax. And if we looked at the housing market, so that's flat, so there's no wealth impact there. Immigration's still relatively low. So, so the Reserve Bank is not going to put up interest rates. I'd be quite happy if they did, because that would mean the economy is booming, but I can't see it really. So from a council point of view, we're a borrower. We need to, just be sensible in what we do. And this is I think every politician who's standing for central government at the end of this year should look at that graph and have to answer and say, this is what my party or my solution is to this problem, that New Zealand's GDP per capita is going backwards. So all we're doing, we've had these, Mr. John Keogh, I know personally quite well because he was a foreign exchange trader when I was, all he did was pump up immigration. So we had lots more people and we're all a bit poorer. He'll never admit that, but politicians will never admit anything. So I'm not for or against any party, right? I just think they're all pretty average. I don't care what party they belong to. And the problem you guys have is they're going to impose more on you. Rate caps. Well, let's make local councils do a whole lot of stuff and then let's give them no funding and then we can blame them. So you've got a few issues coming out of this election, right? Because you're the easy target to blame. Because you're putting up, Auckland's putting up rates by 7.6%. Now, they waste a lot of money, don't get me started in Auckland City. But in general terms, councils are spending a lot more money because of the compliance, the cost. Let's do a 10-year plan. Let's revise it every year. Let's do it in 3 years. Let's spend hundreds of thousands of dollars on stuff that you don't do at central government. I really feel for councils trying to balance their budgets. I mean, there's always savings to be made. You can always do things better. You can always be more efficient. But at the end of the day, I get this horrible feeling that you guys are going to get a bit of flack going into this election because you're an easy target, and it's not going to be fair, but that's so you're going to have to be ready for that as well, because people are going to be grumpy, right? Because this is going to go on for a little while. So, immigration, yeah, I mean, people may stop leaving because Australia isn't looking so great now. The exchange rate kills you if you're leaving to go to Australia and you want to buy, you're selling your house and buying up. Well, that's a bit of a problem So that might slow down a bit, but certainly we're not going to get that immigration-led boom we've had previously. And immigration is an issue, In Australia, the big thing is that, Pauline Hanson and people like that, her big thing is immigration, right? She's sort of Winston Peters from Fish and Chip Shop. But at least Winston's got a lot of political experience, and Winston actually knows, Winston's no fool. He's a very smart guy, whereas Pauline Hanson, I'm not sure. But she's very popular. So if she gets her way and Aussie starts to cut immigration, their housing market's in for a world of pain. Because it's all driven by, we've been there, done that. And look at how it worked out for us. Wasn't great, was it? Our Aussie friends, they should have looked across and went, oh, New Zealand's we normally do things a bit quicker, right, and earlier. They should have thought, oh, heck, that didn't work out. Let's try and slow that down. But Albanese's just gone. And the Conservatives, they're all just as bad as each other. They go, oh, no, let's just have high house prices and everybody will vote for us until they go down. But let's have some good news. The export sector is a really bright spot. Like, we think $10 payout this season is likely again. Last season was over 10. Fonterra just upgraded their forecast just a few days ago. Judging on current prices, $10 is possible. It's going to be high nines anyway. Next season is going to start off in mid-nines. So we're going to have 3 pretty good seasons in a row. Now, we know costs are going up, fertiliser costs are going up, diesel costs are going up. So it's not going to be as good as last season, but certainly dairy's still looking pretty good. Meat prices still looking pretty good. They've come back a little bit with the stuff. A lot of that's to do with logistics and shipping and things, so hopefully that'll correct quite quickly. But our primary produce is looking pretty good. Zespri, before this, we're looking like having a good year. Even log prices are starting to get up. And the good thing is, if you look at that graph, The black one is the NZ dollar index, which is at all-time highs, and the red one is in US dollar terms. So what's happened is our export receipts are the best they've ever been, despite global prices not being at the peak we saw in 2021. We had that big boom during COVID. The exchange rate has been a huge benefit here. A 58-cent Kiwi dollar compared to a 75% Kiwi dollar is a massive benefit for our export sector. And getting back previously, China exporting its way out of problems, we haven't, imported inflation hasn't been too much of an issue, thank goodness. Now, obviously, oil is going to be an issue in the short term, but the Reserve Bank can look through that. So if the export sector and those prices keep up, and our forward-looking models think prices are going to be pretty good, sort of regional New Zealand outside the big cities looks okay. But the problem is, there's 750,000 people, I think, live in the South Island, and there's 5.2 million Kiwis, right? So it's pretty hard. And there's how many farmers are there? There's, I don't know, as a number, they're carrying a lot of New Zealand on their shoulders, aren't they? And they're only 25% of GDP. So it's not enough to get us out of the trouble, but it's certainly very helpful. So we think things are going to be reasonably tough, a lot tougher in the cities, a lot tougher in the metropolitan areas, a lot tougher in Wellington, for example, because there's still going to be public sector problems. Christchurch is sort of going through and rebalancing, people moving there because of, that relativity will come out. But in general terms, the export sector looks like it's going to go quite well for a while yet. So from a Waipa point of view, your key things to focus on is you're going to have higher costs for some things, right? Construction's still really weak, so you should be able to drive some of those contracting costs down. But when there's petrochemical, links like, roading and, driving your vehicles, that's hard to escape. Let's hope it's temporary. So there's going to be some cost pressures. Interest rates, we just need to be sensible about what we're doing. We don't want to be locking in these high interest rates because the risk is flexibility is really valuable, as we found out in the global financial crisis and we found out in COVID. And from a community point of view, it's going to be sort of mixed. But in general terms, your support communities, your farming communities are going to be okay. And as somebody pointed out when I was having a cup of tea, a big checker is arriving from Fonterra. Now, to be fair, a lot of that's being saved. We're seeing dairy, bank lending to the dairy sector actually contracting with debt repayment. A lot of farmers are getting older and are working out their balance sheets and things like that. But it will flow through. So, I'm much more positive for Waipa than Auckland or Whangarei or somewhere like that. You are going to get some stick into this election, and your ratepayers are going to be under a bit of pressure. So, that's the kind of outlook you have. But it's not a disaster. The oil thing will correct, but the fundamental issues are something that, we've had for a long time in New Zealand, and hopefully at some stage somebody will come up with some sort of solutions. So this thing here, if anybody going to Aussie on a holiday, I'd recommend changing to Vietnam or Fiji or Cook Islands where they use New Zealand dollar. When it was at 82.5 cents, it did get down to 72.5 cents, and I think that was during 2010, I think. So it could go weaker, but it's looking pretty weak. We're finally starting to see a bit of Aussie investment happening at this kind of exchange rate. But certainly for tourism, 90% of the increase in tourists we've seen over the last 6 months have been Aussies. They don't spend as much as Yanks. They don't spend as much as, Europeans. They probably spend about the same or more than Chinese, but certainly they're spending. But again, that's kind of localised, right? Queenstown's booming. Wanaka, Queenstown's booming. Aussies, if they come to other places, they tend to sort of, they know Kiwis and they travel around and they stay, but like Kiwis going to Cook Islands, we used to work for the Cook Islands government and, they'd say Kiwis and Aussies are wonderful tourists, not because they bring all their food with them, they stay in a house and they just, drink the beer they brought, they're not big spenders, but because it's like just being at home. It's like going from Auckland to Rotorua, I suppose. You go out a little bit, but you don't, but it's certainly been a benefit. And so that's really helpful. And some of our dairy company clients now are starting to see big demand out of Aussie for butter, for example, because we're looking very attractive. So, the exchange rate is doing what it's supposed to do. It's helping our export sector, which is what we need to grow, right? Again, if you get an airfare, so that's the difference between the black line is Brent crude oil, which went up by, $60 to 120. Well, jet fuel went from 100 to 230. So that's why the airlines are panicking. That's because jet fuel has to go through the Straits twice, crude, processed in Singapore, back somewhere else. So they get 2 bites of the cherry. So that's why airlines, but again, that should correct pretty quickly. So hopefully if this gets over, that airlines, the big problem was because oil was so stable, a lot of airlines stopped hedging their fuel, thinking, oh, don't worry about it, it'll be all right. Or they thought, oh, it's expensive, it's more expensive to hedge jet fuel than Brent crude. We'll just use Brent crude as a surrogate because the correlation was 90%, right? You go, look, I need to hedge my jet fuel, I'll just buy some Brent crude hedging. Well, unfortunately, when that correlation breaks up like that, your hedges haven't worked too well, have they? But again, that's hopefully going to be short term. So for us, quickly, here's where we are currently. This is before the transfers to water. The picture will look the same. It'll just be lower numbers, right? So we've got a little bit of, from about March 30, there's about a $20 million non-compliance, which we've been aware of for a while now. The plan was in April this year when we have got a whole lot of debt maturing, we were going to fill in that back end, and that was going along swimmingly. We're looking at high threes. We're thinking, oh yeah, this is fine, we'll do that. Now we're thinking we can do a swap at 4.5 and not, but we don't really want to borrow from today at 4.9 to fill up a gap in 4 years' time when we can keep borrowing that debt at 2.9, right? I think we need the benefit now, and let's see how things develop. So we'll come up with some plans to sort of fix that little problem. But in general terms, you're at policy midpoint. So this increase in interest rates is not in long-term rates is not really impacting at all. We've been riding the curve down. We've got to remember the cash rate's gone down 1.5% in over a year. We've had almost all that benefit. So you're in okay shape. We think that we don't think your budgeted cost of funds is under any pressure at this stage now or into the future. We've just got to be a bit sensible about what we do. I've talked about that basically. And here's just a graph that shows. So that line, the sort of orangey coloured line, and it's higher now. That's what you pay for 5 years. You pay 4.75%. Now, borrowing for 5 years is mathematically just made up of borrowing for 3 months every month. So 5 4s are 20. So a 5-year loan is the same as 23-month loans in theory, right? So the yield curve works out. You should be ambivalent. If markets are efficient, whether you borrow today for 5 years at a fixed rate or leave it floating for the next 5 years and just pay it, it should come out at about the same if markets are efficient. And markets are sort of efficient, but currency markets are really efficient. Interest rate markets not so much. But the big thing why this implies that at current rates, the gap between the blue and the orange means borrowing fixed is never ever going to pay for itself. Now the main reason is that when you borrow off the LGFA for 5 years, you pay a margin of about 1%. When you borrow off the LGFA for 3 months, you borrow at a margin of 0.2%. So by borrowing short, you're saving nearly 1% in margin. So all things being equal, short-term interest rates have to go up 1% just to take out the margin benefit before they even start, So mathematically, it means the maths of borrowing long-term at the moment are really quite punishing. And the reason why those margins are so different is because, unfortunately, the longer-term borrowing from the LGFA depends on what the New Zealand government pays, right? Because the New Zealand government pays a margin, and then the local LGFA pays a margin slightly more than the government, even though it's AAA rated as well. Now, you might have seen in the paper, we're on negative credit watch. If we get downgraded, that means the government pays more. We've got this really weird situation, which no politician ever talks about, maybe because they don't understand it, but it's not a good thing to bring up, is that the swap curve, which is when you have your mortgage, right? If the bank says you're paying 6% on your floating rate mortgage, the margin is based on BKBM, which is the 3-month interbank rate. So that's the bank that banks lend to each other. Then they add a margin, and let's say it's 2.5%. So then they say, okay, that's where we'll do a floating mortgage. When you borrow, if you wanted to borrow for 5 years, The banks don't use the government stock rate or the LGFA rate. They use this thing called the swap rate, which is again where banks borrow for that 5 years. Now we've got this really interesting situation at the moment where a AA minus rated New Zealand bank, or in fact one of our clients, Auckland Airport, A minus rated, can borrow at a lower margin than the LGFA, and not a margin too far away from the government. The reason for that is the whole world is full of government bonds. All investors have got so many AAA government bonds coming out their ears because guess what? There was trillions written during COVID, and New Zealand added 50 billion worth of 100 billion worth of bonds to its supply. The whole world's going, yeah, we don't mind having government risk, but we'd probably quite like some exposure to something else, you know. So they'll actually pay to have something else other than government risk. So historically, the margin between what you'd pay the LGFA for 3 months or 5 years was not much different. Now it's 1%. So that means it's really expensive for certainty, even with the yield. And the yield curve means that it costs you 2.8% for 3 months or 4.8 for 5 years. Then you add on the 1% extra of margins. You can see the math starts to look, the cash rate's got to get to 6 or 7 or something for you to be worse off, quite frankly, over the next 5 years. So it kind of, as your advisors, we're going, the maths really doesn't work, you know. If we thought the economy was going to just boom and we were going to have this massive growth cycle and everybody's going to be driving around in Rolls Royces, we'd go, yeah, let's go because the Reserve Bank's going to tighten aggressively. That's kind of our 1% out of 100 probability, right?
We've got about
okay. So I think I'm just about that's me done.
Yep. Right. Great presentation. Loads of information. Questions? Questions for Earl?
Probably stunned you.
No. Good. Claire and then Liz.
Yeah, I just want to ask you about the rates capping and what you think we should, respond to along that line. You sort of touched on it, but, you know, like at a practical level, yeah.
You can't escape it. I mean, it's going to happen, right? And it's going to be more, I think that if anything, it'll be more aggressive than they're talking about. Because what they've said, rate capping, excluding water expenditure. Now they'll say water's gone, so bad luck. You guys need to be at 2. Yeah, they're going to be very aggressive in this because see, you've got Winston talking about splitting up the gentailers, which to me they should never got put together 40 years ago. That was so that's a very good idea, I think. But there's going to be lots of the stuff coming out now because people are going to. If you're a smart politician, you need to focus on competition in New Zealand. So that's supermarkets, it's, all those banks. You mightn't get anywhere, but that's what I talk about. And they'll blame council. So you're going to be lobbed into that sort of cartel, do what you like sort of category. So I think they'll be tough. I think the risk is it's tougher than what you've currently seen.
God, what do they call you again? Good New Zealand. Good New Zealand. All right. We'll go Liz and then we're going to finish up with Pip and I think then we're going to be done.
When the banks are bringing in their short-term mortgages and they're offering good rates, it's usually because they don't want to do long-term ones because they don't want to get stuck with inflation. So the short-term might look good, but in the long run, the long-term rates are probably better if you don't want to take a risk.
There's always a cost in hedging, right? And you've just got to look at the mathematics and what's going on in the marketplace. Now, the reason why the banks are offering competitive short-term at the moment is because they can make the rate headline look more attractive because of the shape of the yield curve. And the reason why they've got a bit of an issue with long-term rates is because the New Zealand long-term market's very illiquid, right? Our long-term rates have gone up probably 50% more than the equivalent US rates. That's just because if you try to do 100 million in our market, it moves the market 0.5%. You do it in the US, it doesn't move it. So our long-term market is more illiquid. So the banks are scrambling to get stuff done. At the end of the day, banks don't take risk. So if they write a 5-year mortgage for you, they've hedged it. They're not sitting there going, oh, we'll take the punt. They don't care. They don't care how long you borrow for because they've hedged it away. The bank's risk on their mortgage books is very, very low. Banks don't run big risk positions. They don't need to. They've got a 2.5% margin on their cost of funds versus what they lend to. But why would they take risk?
Message to negotiate hard. Right, finish up with Pip.
Thanks, Earl. Great presentation. I'm really just sort of wondering whether it would be possible to, through our CFO, we get a copy of your presentation because, really good material there. And so as a revision, it would be great just to go back on some of your slides, and if we could have them, that'd be fantastic.
Well, look, I've got no problem to have these. There's nothing confidential in these other than your own, your profiles. If you want to take them out, I don't mind at all. I'm happy to have them, selected. And anybody's got any questions, I'm at the end of the phone. No problem. You guys are clients. You guys are, just if you want anything expanded on, just give me a call. Yeah.
You've got 1 minute all up. Ask and answer, and I'm cutting you.
Net migration has just seen a good increase over the last couple of months. With the deterioration in the Aussie situation that you've mentioned there, are we going to see that having an impact on our migration?
It will probably slow down New Zealanders leaving. So at the margins, so we might get back to 20 or 30,000 a year rather than zero, but it's at the margins. Minimal, yeah.
Right, thanks to that team. I just had confirmation that that presentation will go into diligent. I mean, we're in public, so the whole thing's public, so there's no issue there. So, hey, thank you very much for that presentation. You're a man who absolutely knows your field, and for the rest of us to hear that and then to maybe synthesise it with the presentation tonight over a cold glass of water or an orange juice would be very good. So, look, thank you very much for coming in. Thank you, James, for introducing Neil. Yeah.
Resign and get out of here. I end up staying to do a good job.
I got a, right. I'm assuming there is no debate between us. We can just move and second this. Happy to do that. Right. So if I call for a mover and a seconder, thank you, Shane. Thank you, Claire. All those in favour? Against, carried. Tell you what, Brett Olsen's got to step his game up because that was pretty impressive. Right. No offence to Brett Olsen, because he is also the man. All right. So now we're on to our eight-month report. Now, this is a biggie, and hopefully, well, not hopefully, I know we've all read this. There's a lot of very good information in there, 35 odd pages of it. And so I'm going to head over to James, to Nada, and to Tommaso.
Thank you, Mayor Mike. Thank you, councillors. Yolanda's filling in for Nada today. Welcome, Yolanda. I almost called you Nada as well. Hey, look, we'll keep this very, very short and open it up for questions. We're conscious that the most important thing today was hearing from Earl. So I'll just quickly run through a couple of things in terms of my CFO overall commentary, which you will appreciate and hopefully like. So just a quick update. This is the 8-month report. This is the second reforecast for the year based on our 8 months of actual results, and provides a good indication of where we expect to land for the year end. It also helps us to establish the baseline for our 2026 and 27 annual plan. As I mentioned, we've delivered 8 months, so we've got a good feel for that now. All activity managers have completed a full operating and capital delivery reforecast, so that report reflects that. This is effectively our last reforecast for the year, even though we'll endeavour, as per previous years, to provide an updated 12-month view prior to our annual report being audited and signed off, which we know comes later, post the close of the year. So we will have that. Obviously, it'll be unaudited. A few things to note, because I'll keep it very brief, because Earl's obviously covered off our strategy around debt financing and stuff, and obviously did a better job than I normally do. A few things to note. So the property sale, if you exclude the property sales revenue, the disposals, which aren't operating revenue, we're slightly ahead of full year budget, and our OPEX costs we're slightly ahead of as well. So we're well within limits. And in terms of our CapEx reforecast, you'll be aware and you'll see that we're significantly lower in terms of CapEx delivery for the year. That has a couple of impacts. So, for example, obviously you'll see on the net debt levels that we're significantly lower than what we budgeted in our LTP. So that's obviously good for headroom and interest rate costs and the likes. And that you'll see that on page 31 of the diligent pack. Finally, because I'll keep it brief, on slide 30 of your diligent pack, you'll see our key financial risks there outlined. We're in line to meet all of those, including our LGFA covenants for year end. The one thing I do want to note is our growth numbers are still based on the 4-month report. And that's due to our recent revaluation and our district-wide revaluation and factoring in objections and things like that. So that will come hopefully in our 10-month report. So I'll open up for questions and we'll take the report as read.
Right, thanks for that introduction, James. Righty, so a lot of good information in here, and all those big key numbers are heading in the right direction, which is nice. Though, of course, you know, CapEx being down, chances are most of it's going to get done at some time in the future, no, not necessarily all of it. So we'll go Pip, Claire, Roger, that's what I've got here. And anyone after that for now? Right, we'll take you three for a start, so.
Thanks, James. First of all, congratulations to the whole team to sort of bring just-in-time CapEx finally into being. Very pleasant to see. I know I've been running this for quite some time, but I think there's a critical number that we don't see, which is our growth debt levels. In other words, debt that has been expended and is growth and is related to growth, minus the development contributions payable. And on this basis, the sort of those numbers are 229, give or take in terms of debt, but only $75 million worth of development contributions payable by developers, which therefore you take 229 and take away 75, you end up with around about $150 million worth of growth assets that have got no development contributions coming into them. And that is a big number to finance at 4.25%. You do those numbers, it's a big operational expense for ratepayers. And just sort of given the fact that we are still over-invested in growth assets, how long will it take us to get back to a scenario where our growth assets are within cooey of our development contributions coming in?
So to answer your question, if I could maybe put it a different way in terms of the answer is, so what you're asking is how long is it going to take us to collect the revenues to pay the CapEx that we've borrowed to fund growth?
I mean, it's sort of at the end of the day, how long will we get back into a form of balance? I'm accepting that we're never going to be in perfect balance because, we're talking about long-term assets to generate and et cetera.
Yeah.
But we seem to be out of kilter that our growth assets are too big relative to the demand that we have, and that number to me is the indicator number.
Yeah.
If we'd continued on with your development pathway as per the 4-month report, you would have spent another $60 million, which you would have had debt limits, which would have made it $210 million that we're going to have to fund as opposed to $150.
Yeah, so we adopted a financial strategy for our 25-34 LTP that growth pays for growth. So we spend CapEx today. This was in all our adoptions of our rating and policy and growth assets and financial strategy. So these are clear, as you say, Councillor Kepthorne is in the first 4 months of that LTP. We spend a significant amount of money on growth assets via CapEx. We borrow for all of it, and then we collect the money off the revenues off the developers as the assets vest, right, into service. Now, so it's a timing delay. So those developer contributions come later on in the later years of the LTP because you can't collect it until after you've built it, right? So to answer your question is our LTP only covered 9 years. That life cycle could take longer depending on when the developers build and deliver so when they finalise their subdivisions, once we've put the assets in the ground or on the roads or parks and reserves, etc. So it's a timing
But we
issue.
already have the assets sort of sitting there. I mean, the reason we've got debt is we've actually purchased those assets, we've used debt for.
No,
But the
that's
development
not
contributions
strictly
are
true.
still relatively low compared because at best, we're going to collect $75 million worth of development contributions and more potentially will come. But right now, if we wanted to, we're still exposed to substantial growth.
No, that's not strictly true because as we develop our assets, whether they be water, roading, we have work in progress through that, right? So it takes time to put the assets in the ground or on the roads. So we can't collect the contributions until after the developer has finalised the subdivision via 224. So it is, I'll say it again, it's strictly a timing issue. So to your point, Councillor Kepthorne, and I absolutely agree with you, is during our 2737 LTP process, there'll be a key question there for councillors around the speed of delivery of infrastructure. We've heard from Earl that potentially there's a bit of a slowdown coming. And what does that look like for councillors? So we will work through that. I mean, if there's anything to take positively or note out of this is with a delayed CapEx program, it does reduce the upfront CapEx delivery and the dependency on the DC revenue collection.
Right, thanks for that. Claire.
Yeah,
Evening.
thanks. I've got about 5 questions, but
Oh.
they're they're pretty easy. Yeah.
Yep.
So the first one is about the DCs. I just wanted to show you that I think what Pip's talking about is that
Yep.
graph there, which is on page 33 of our diligent pack. And that's because up until 2020, you could see that what we issued and what we collected was pretty much the same, which I think is what Pip's trying to point out. And then my question was going to be at the far end, where you see our teal bar, what we've actually done is actually dropped significantly. I was going to ask you, like, what's behind that? So you can see the dynamic of that bar graph has changed substantially. We've got a far less amount issued and even less collected, and the amount payable is also a tiny percentage of the previous year. I mean, is that saying a huge slowdown, or is it more to do with the deliberate slowing down of the
Timing
capital
of the
program?
payments, Claire. So you'll see in this 8-month report we've receipted, we've built our forecast this year for an extra, Yolanda, remind me of the amount, was it a couple of million of additional DCs?
To 2.2 million.
Now those related to 2025. So you'll see that in the corresponding chart. So it's a timing issue around the collection.
So what you're saying is the forecast is we'll have pretty similar levels to say 2024, but these are just the ones that have been issued, and therefore, so it's not quite okay. Well, that's quite helpful actually. Yeah. Thanks. Cool.
So if you look at 25, 26, the table next to it, you see our actuals at 7.35 versus a forecast of 10.5. When we reforecast that number, right, it will include the DCs from the prior year that are timing late, right?
Right.
So and this does underpin Councillor Pip's comments as well.
Yeah.
This is a timing issue that actually is out of our control because it's related to the release of the land. The control we have is about the delivery of the infrastructure.
Yes, I think we might want to talk a bit more about how we could get reporting that reflects those different timing things. Yeah, cool. No, that's very helpful. The second question I was going to ask was about the wastewater treatment spend, because I'm expecting huge amounts being spent in the Cambridge wastewater treatment plant. Now you've got different categories for spend. You've got new CapEx, you've got levels of service and renewals, but I'm expecting lots of money to have been spent on that wastewater treatment plant, but I'm not seeing it, whether it's in
Page
24, I think 24, wastewater, There's actual 7 million and forecasts of only 17 million, okay? But then when you go into the other graphs about the levels of service, which is supposed to be a third of the wastewater treatment plant in Cambridge, and renewals, which should have been about a third of the wastewater treatment plant in Cambridge, they're tiny. So it didn't seem to be matching in my view. I just wanted to understand it a bit more.
I think we'll come back to you offline once we've spoken to EO about that one. But I do know, EO, I don't know if you've got a question for it? If you've.
No,
Okay.
I need to actually understand that question.
Yeah, okay.
Yeah, cool. I know, that's great. And then there was one on page 37, which is the statement of financial position and the increase in investments in CCOs. So this is the forecast of what it's going to be by year end. And that's, so it's going to increase by $8 million, I think. Yeah. So that we've got to 42. And I'm thinking, again, why would we be increasing our investment in CCOs?
So Claire, that increase is because of borrower notes that we need to take out with the LGFA, which for this reporting we count as investment in CCO.
Oh, no, thanks. Yeah, that's really helpful, actually. Yeah, I keep forgetting about those borrower notes, actually. Yeah, and so they're actually reflected in that. Oh, cool. Thank you for that. Then my next question was, we usually have an update on how we're going with our rates collection. So I didn't see that in this report because I am a bit worried about whether or not we're going to see a slowdown, you know, people struggling getting their rates paid on time and things like that because of the emergency that we've had. Is there any update on that?
Yeah, so I don't have the figures offhand. We normally don't include it in the 4 and the 8 month. It's in every other report.
Okay.
We can pull it together and circulate to members.
I think it would be quite good since we've got these special circumstances. Yeah, it'd give me a bit of reassurance, actually. That's all. Yeah, cool. Thank you. And then the last one was actually just a typo in the recommendation. That's all, because it talks about a depot that's only doesn't have a T in it. Yeah, yeah. So that's all. And I'm hoping that we're going to get special time to talk about the comms and non-financial report. Yeah, because I've got some good things to say there. Yeah.
Thanks, Pat. Roger.
Yeah, thank you. And I'm pleased Claire came before me because she's actually asked some of the questions. But it's very much of a perception of what it's going to be like going forward. And certainly the reduction in our capital that we're seeing now, when we go to the end of the year and we've got that transition to Waikato Waters Limited, with a lot of our future capital commitments are actually going to be transferred as well. So our capital demands, combined with the fact that we've got a lower capital drawdown now, is going to mean, to my mind, that when we get to July the 1st, we're going to be in a far better position and far more in control in terms of our ongoing borrowing commitment. Would that be correct?
You are going to really look forward to tomorrow, Councillor Gordon, for the financial strategy, because you've hit the nail on the head. Our entire financial strategy and challenges between the existing financial strategy in place and the next one are completely different. I'll give you because I like to talk like Earl as well. I'll give you a precursor. Is in the current one, it's all about debt headroom. In this LTP, the future one's all about revenue. And listening to Earl talk about potentially a further rates cap makes me want to cry, but that's okay. I'm not the only one. So yes, you're quite right, Councillor Gordon. It actually significantly frees up headroom for remaining council.
Shane.
So James, looking at the P&L, our actual page 34, I think it is, the statement of comprehensive income. So the question is, how confident are you, because I'm new, in your ability to forecast? Because when we're in the 8th month, and over the first 8 months, we've lost 1.6 million, but year end, we're going to be 10 million up. So therefore, we've lost 1.6 over 8 months, but we're going to actually make 11 million over the next 4 months. So I'm feeling a little bit nervous about that, and there may be some good explanation that you'll be able to give me. And the other reason I'm nervous, because when I look at some of the revenue actuals compared to the forecast, although we're 66% of the way through the year, some of the business units have only made about 20% of their income, but are expected to make 100% of their income at year end. And just to give an example, the museum, for example. So my question is, how confident are you with your forecast?
That's a bit of a loaded question, really, but it's a good one. Look, our revenues in the last quarter, we realised a significant amount of revenues because a lot of it's tied to grants and subsidies. In addition to that, our DC revenue collection comes in later in the year. So it always looks like our actuals are running under when we forecast. As I mentioned, our activity managers forecast their numbers, and we rely on them for that because they're on the front line of the business. We obviously test that in the finance team. In addition to that, you'll see on the fees and charges businesses that we're ahead, quite significantly ahead of what we forecasted for the year. So, and in terms of rates collection, we're doing fine. So it's those items that may or may not catch up. We need to be really careful when thinking about revenue from the property disposal and sales, because we don't use that to fund operational expenditure. That effectively comes in to pay debt. So, so just ignore the property line, and we've talked through this previously as well. So I'm confident at this stage we'll have more certainty, obviously, in the 10-month report. But as you say, it is forecasting, as Earl outlined earlier. If we all knew the exact answer, we'd all be multimillionaires.
Have you ever had it run a system instead of forecasting that you actually compared to a seasonal budget, so that those ups and downs you can see them within, you're comparing the time of year and what you expect to see at that time of year with your actuals and your budget? Have you ever looked at that as a system versus a forecasting system, which to me has a bit more risk?
I don't know if you've got anything to add there, Yolanda.
I think the forecasting is important, especially when we get to the CapEx, to see what we can actually deliver and then position our debt with that. Similar to our expenses, you get to a point where you're like, this is how far we've gotten. And at the 8-month mark, we've got another 4 months to go. So we look at the reforecast of where we're going to end. Seasonal would come into play, but then your budgets are static. Yeah. So I think you lose the benefit of viewing what we're going to end on in 4 months' time.
Yeah, I guess it's just what I'm used to. We still forecast, but we then compare our actual versus a seasonal budget, because sometimes you expect some income in the last quarter or whatever, but it gives you a little bit more comfort when you're comparing your actual results to a seasonalised budget. Because you think, okay, we're heading in the right direction, whereas we're 100% relying on you getting that forecast right. So,
I think if you look at vested assets, for instance, I understand the point. We're sitting at 1.1 million against the budget of almost 12 million, but that's because vested assets comes in towards the end of the year. Yeah. So then you see that spike. So if you had that seasonal view, that would possibly help with the description at the bottom of the report.
Yeah, and I look at something like subsidies and grant, and the fact that our team have forecasted a higher full year forecast than what we budgeted, but we're running at only 36% year to date. So I take the point on seasonal. Our systems don't work that way, and I've got to be honest, the capacity to do that, Shane, would be quite difficult. So I guess there is an element of professional judgment that our staff use and we use to review it. But I understand the question, I understand the point.
Yeah, I mean, you might be really, really good at forecasting, but I haven't seen that yet. So, yeah.
All right, I'm just picking up on Pip's point before turn. I just want to make a comment, and it probably feeds into tomorrow's workshop. But back in the day, I don't know whether it's official or unofficial, but subdivisions, the new one wasn't released until 80% of the old one was sort of was sold. Therefore, our debt at that point in time was sort of fairly minimal, and this sort of change of policy or tact, and now of course being a Tier 1 council, almost legislated, is a part of the reason of why this debt sits there, and it's come on in the last sort of 10 to 15 years fairly rapidly. That's just a comment.
Question of clarification on that. So was one of the triggers for that change you're saying is the NPS on housing development? So being able to provide a 30-year supply ahead of time and provide the infrastructure for that, was that a tipping point in that change in our policy of being able to wait for 80% of a subdivision to be occupied, or to form the trigger for the next one to be unlocked? Was that one of the tipping points in there for Waipa? I'm trying to understand what that change was.
I want a clear answer there.
Yeah, definitely. I can remember where we used to limit the opening up of any new growth cell until 80% was full in existing ones. And then I remember we had the directive from central government, we had to provide forward availability, 30% or 20% plus. And so there was a move to open up all of the deferred growth cells that had been sitting there until 2025 at the time. They were just all opened up at once, and it was definitely because a response to the government policy. Thank you. I'm sure Wayne can say that as well.
Right now, I'm just going to try and manage this. We've got until 10 past. We have got a full agenda with people coming. So, Monty, you talked to the finances, and we might just have a couple of statements on the rest of the report, which is a lot of good news stuff around the comms. So, Monty.
Okay, I'll just limit myself to one question then. Treasury management policy showing our upper and lower limits. Just a query why Earl's chart showed a $20 million hole and ours doesn't. Page 34 of Diligent, Treasury management policy, we show full compliance by my reading of that graph, and I was surprised when Earl said there's a little hole there. I was like, well, I haven't seen that before.
What page, Monty? 34, there's a table, there's no graph.
32, sorry, 32. Within the outer years, Earl identified as a little $20 million problem. I'm not seeing it.
Right, so maybe the true financial part of this, James, Yolanda, Tommaso, they're happy to take emails after this if we do have some more questions. But I do want to leave just a few minutes for the rest of the report and just any comments or already any questions to that. All right, Claire and then Joe.
Yeah, it was a lot about the comms work that's been going on, and I just want to give a huge shout out to the work that was done during the Pirongia emergency, because the decision was made to deliver a hard copy updates to the community and have them at the local stores and things like that, and that was greatly appreciated, and that wasn't in the report itself. And secondly, something else that we've instigated as a new council was to do video updates after our meetings, and that also has been well received, but it wasn't included there. Yeah, but I think that's been a really good move as well.
Right, Joe, your statements were made. Yeah, look, hey, it's great to see the data is actually all trending in the right direction. It was one of the sort of things that, the table as part of our induction was actually to try and improve this piece and do our bit, and the staff are definitely doing their bit. So gets back to rising tide raises all ships, and we're in it together. So great to see that as part of a monthly report. All right, so any more questions for the staff or anything else could go offline? So thank you, Tommaso. Thank you, Yolanda. Thank you, James. Thank you very much, Jill. Thank you. Hey, any questions, debate for us? All right, happy to move that 8 monthly report. Let the Financial and Corporate Committee receive the report from Amy Turner and Management. Oh, sorry. Financial and Corporate Committee. So we'll just go A and B. Remove A and B. Claire moved. Pip seconded. All those in favour? Against? Carried. Thank you. Good questions. And a couple of ideas in there to put onto the next report too, which is fantastic. Right. What we're going to do is, what time do we start? 1. So we're actually going to take a 2-minute recess and we're going to start back in about 12 or 13 minutes past. So just a quick break and then we'll stay online. look, Les is, so Claire will take care of that. Les is just making a quick, oh no. We will go back live. Right, thanks for that, team. Thanks for that. What we're trying to do is just so we stay fresh and so we stay focused. Sort of each hour is trying to take just a 2 or 3, 4 minute break just to keep us all fresh. All right, now I'd like to introduce, is Sally Sheedy here? Sally's going to introduce, okay, the Hamilton and Waikato Tourism 6 monthly report from the 1st of July to the 31st of December 2025, and Nicola Greenwell from Hamilton Waikato Tourism. Welcome also.
Tēnā koutou katoa. I'm pleased to present the Hamilton Waikato Tourism 6-month report. For context for the new elected members, Hamilton Waikato Tourism operates as the region's regional tourism organisation, and this is through a co-investment model combining both public funding and private funding. Council has a service level agreement with Hamilton Waikato Tourism, which stipulates 2 reports per annum, so this is one of those reports. The report highlights strong performance across the first part of the first half of the year, including exceeding marketing reach already in terms of those targets and positive visitor activity across the region. Hamilton Waikato Tourism plays a key role in promoting the region, which includes Waipa tourism offerings, as well as supporting economic outcomes for our communities. So as already mentioned by Mike, I would like to introduce you to General Manager Hamilton Waikato Tourism, Nicola Greenwell, who will present her report with you. And we have a presentation that Zoe's going to share for us.
So Nicola, just so we get the timeframes right here, and to be fair on you in questions, we're going to run through to past, and then we're going to allow 5 minutes for questions, okay? Well, thank you.
I hope I don't even talk that long, Mayor. Look, thank you. It's lovely to be here and see you all. Welcome to the new faces, and welcome to the returning faces. It's really good to be finally in front of you. So as Sally has just pointed out, your report that you've got in your pack covers the first 6 months of the financial year, so through to December. Feels like we're already racing ahead, and my brain's probably more on this time of the year, but we'll go through. What I have done this time is taken the liberty to include a few extra slides just to help you understand what an RTO, a regional tourism organisation, means and does, and how we fit into the ecosystem. So bear with me, I am going to whip through them. I know it looks like there's a lot, but we will get through. Just here, I've just wanted to point out that there are 30 regional tourism organisations, RTOs, up and down the country. Every one of them seems to have a different ownership model, different funding systems, and we all work in different areas of delivery. So it's not a very simple product at all. Some are part of the economic development agencies, some own and operate the eyesights, some don't, and just the really mix of funding models. Many have public and private investment like we do, but a lot are also purely public funded. So it's a really complex layer of the tourism sector. But all of us, we all exist to attract visitors to our place. So we're all wanting to strengthen both the demand and supply side of the tourism system, creating visibility, alignment and coordination across the region's experiences, operators and infrastructure. This is our place. So as you know, we are a collaborative with Waipa, with Hamilton City, Miramata Piako and Waikato District Councils. It's a service level agreement, which Sally has just pointed out. So collectively purchasing those services from us as your RTO. Our goal continues to be to attract visitors to our place, encourage them to explore a bit deeper, stay longer, spend more, so that our businesses are viable and sustainable, resulting in employment in our communities. So we make things really complex for ourselves. This slide shows the areas that we look at. We don't just put out a marketing campaign without thinking about these 16 components. How will people get here? What's their experience they're going to have when they're here? Is the infrastructure there to support that number of visitors? We had a content shoot just last week that the event asked for a site of significance, and we actually had to decline it because that site would not have coped with what the resulting visitation would have had, in conjunction with that council. So we always think about the broader picture. It's not just about putting out that message. The circles on the right are how we work as a team. So we have a team that operates across domestic, Business Events Australia, helping capability building of our operators and digital. That's a really quick whistle stop on what we do. So moving into the report itself, our country, we've currently just tipped over the 3.5 million visitors. That's November data there. It's just hit the 3.525. So that's still at 90% of the visitation levels from the pre-COVID 2019 levels. And we know that our central government have got are very driven to see the country return to those pre-COVID levels of international visitors. And that's why we had the Regional Tourism Boost Fund come out in the last few months, which I'll talk about later in our deliverables on that. This one is our own data. So visitors spending a significant amount in our region. Now, this is only electronic card transactions, and I get some of the data is a bit tricky to keep a track of, so I'll try and explain it as we go. But visitors spend electronic card transactions only. It does not estimate or include online spend. So if anyone's booking their tickets online and paying online, is not included. Any cash, I don't know if anyone's using cash anymore, but that's not included either. We're hoping that we'll get the old school data back soon, which does estimate both of those things. But at the moment, this is the data that we've got to share with you. The bed nights in front of you, the 1.23 million guest nights, again, commercial accommodation only. That does not capture the short-term rental. That's quite challenging to capture. However, what we've seen is that the data shows our region achieved an occupancy rate of 59%, which is 5% better than last year. We sometimes hear our local communities, our local residents doubting, why would you work in tourism? What's there to sell? Well, bully to them. What we can see here, and I wanted to really point out and reiterate, is that our visitor spend there, you can see we're fourth for visitor spend from the domestic market, only behind Auckland, Christchurch and Wellington. Fifth for international, and that often surprises people. So we're behind Auckland, Queenstown, Christchurch and Wellington. Some of our neighbouring regions that we think of as high international visitor mecca, I'm not going to name a name, but in that way, is down the rankings from us. We punch above our weight in what people often think of. We're seventh there for the commercial guest nights, and that's behind all of those others, and Rotorua and Northland. Fourth for the business events. Now that's quite significant. We're behind Auckland, Wellington and Christchurch. Now all of those three centres have fairly sizable new convention centres. So we do know that they're our competition really, but we are finding our niche in our own backyard as well, and largely in the association market. So if you ever hear anyone saying, what has that region got to offer? Please try and remember these, that we are fourth and fifth for visitor spend. It's really significant. These are our KPIs that are in our statement of intent with you and our other councils. So we can see here that we're already tracking fairly well on most of them and almost meeting some of the others. What I wanted to point out though is the visitor spend for domestic. Our target, we have not met our target yet of 790 million. And the arrow shows down. Now there is a downwards trend there of 1% year on year. Put that in perspective, the country as an average is down 5%. So while we have tracked down, we are tracking better than some of our other regions. So while some of them might not always look like they're met, they're tracking really strongly. More numbers than what you really want to take in on a day like today in here. Our Get Lost campaign, the second iteration was in August, and our third has actually just finished on Monday. So this one here in front of you went into Auckland. The one that's just finished was Auckland and Christchurch, to tap into those extra jet services from Christchurch. And the numbers that we've seen just even so far, only just finished on Monday, haven't analysed it, but it looks like a really strong reach, particularly in the Christchurch market. One flight. So this is the campaign that we ran in November, because that's the timeframe of this report, with our neighbours of Bay of Plenty and Rotorua, so directly into Sydney. So we worked together to have a little bit better marketing and media purchase buy than what we could have done on our own. Again, all of those analytics there are highly successful in forging much better than the average return on investment. But what probably is more important and of more of interest, as you may have seen, the government did announce regional tourism boost funding, and we were successful with our application. So we'd always planned on a second iteration of that one flight campaign, but with Ruapehu and Taupō. So the boost funding has enabled us to broaden that, go into market for longer, and really deepen our targets. And we've also looped in Taranaki and Waitomo in that activity. 459,000 on one campaign is more than we have ever put into one activity, one market at one time. So it's been fun, it's been challenging, and it's bloody rewarding too. If I can say that, I just did say that, didn't I? So the analytics coming out of that one, we're still live in market at the moment through all the Meta and Google network and all of those normal channels. We've spent quite a lot on the Jetstar Australian website as well. We've got a lot of hospitality work going on with that one. We hosted Janice, a curator, culinary curator from Sydney across all 4 regions 2 weeks ago, and her coverage is coming out on YouTube right now and getting great engagement. We're about to launch Come Dine With Us vouchers through the Restaurant Association to our Australian visitors. So there's a lot of different thinking through this campaign that we've been able to do. And at the next report, we'll be able to share a whole lot more of what that has actually meant for our region. Before I get to my thank yous, I've got some extra data here from being on a bus with some of you at Auckland, at Hamilton Airport, and some questions that were asked of me. So I've got some data to share that's not in the report, because we report by region and by district, and some data doesn't go down to town level, but we've dug a bit deeper. So the question I had on the bus was, what have we done for Pirongia and Te Awamutu? And I'm looking at you, Councillor Shane. So I have got some extra data, and it looks a bit of a mess, so I've got to get my way through. The girls have provided this to me, and I've highlighted bits and then circled other bits. So the website, Waipa pages of the website, particularly around Cambridge, Te Awamutu, Pirongia and Te Arawai journeys, 28,000 views. Social media, I'll just pick on a couple of things there. Alpha Lavender seems to be really popular. Views, 83,000 views, reaching 56,000 people. Kaniwhaniwha Caves and the walk at Pirongia, 57,000 reach with 40,000 views. Te Arawai journeys, 59,000 views with 42,000 people reached. So there's a lot of people being reached with our activity, just with those things alone. Obviously, our commercial operators have listings, so these are the activities that we're doing for places that don't have listings on our website. So that doesn't include any of the Sanctuary Mountain Maungatautari, Karapiro, etc. We've also provided, as you know, support for our sector, one-on-one support, go along to existing operators or new operators and help them navigate their way. Sometimes it's just giving them some pointers, sometimes it's connecting them with other people. So we've provided 35 operators with one-on-one support. 10 of those have been in the Waipa region, Waipa district. So we're definitely touching in and helping your operators. This year, the symposium speaker gifts were actually a donation instead to New Zealand Landcare for the ecological corridor from Maungatautari through to Pirongia. So we're definitely touching into not only Waipa district, but in and across all of your towns as well. Other than that, thank you for your part that you play in supporting your local RTO. It really is important, because it's important to the tourism sector. It's important to those people who work in our sector. So thank you.
Right, thank you very much for that thorough and succinct report. So thank you, Nicola. We're going to start off with Marcus.
That was awesome. Hey, with the growth of the jet services and all the work that's happening here with tourism, how likely is it that our cousins further south are going to rejoin?
Am I allowed to pass on a question?
Oh.
Look, we've constantly kept touch with the operators to see what they're feeling on the ground and what's happening. If there's an operator, a new business wanting support, we do need to push them back to their council and try and highlight that to the council of opportunities missed. They're rapt that they're included in the one flight. And we did that because it was government funding, not your ratepayer funding. So we keep that really quite a clear circle around that. And I think we've done that really well because we don't need or want anyone else's ratepayers subsidising, right? And we're really conscious of that. I really don't know, unfortunately. We'll see what long-term plan brings. Rest assured we'll be in there with submissions and advocating for that.
Thanks for that. Good question. Dalmarie, and then Claire.
Tēnā koe, Nicola. Oof, your data on some of those cliff stuff, that's mean. Just wanted, I missed that lady's name from Sydney.
The which from, oh, Janice Fung, F-U-N-G, Janice. I can send the link for her YouTube channel if you like to, Sally, and that can be shared. 2 of the 3 videos are up live now, and they look phenomenal. We're actually going to also, so while the videos are, sorry, I'm going AWOL here, while the videos are about the 4 regions, we're actually going to pay her to, and it's a chronological of her trip, we're actually going to have her break that into regional bite sizes as well.
How many Māori operators do you have?
Oh, I'd have to go back and look at the list. I haven't broken it down that way. We've provided, I have got some.
All goods. Oh.
I think there's about 10 that we've actually provided one-on-one support to. Yet exactly 10 provided one-on-one support to cultural operators so far this year.
And last from me, Matatini.
Yep, so we provided some stats and information to help support 2 bids actually, including the winning bid for that. And we've already provided our visitor map for the committee who are travelling the country to encourage application or entries. And so we've provided that, they've got that on the road with them. And we've offered our support services when the committee get together from a hosting perspective to broaden that time and region. We'll do as much as we're able from the committee. Yeah.
Awesome. Thanks, Nicola.
Thank you. I will go Shane, then we'll go Claire, and we'll see how we're going for 25-2.
Thank you very much. It's nice to see you here. And thank you for us answering that question about Prongia that we talked about on the bus. So I'm very interested to see that part of what you do is to create experience and product development. So it's great to see what the picture is right now, but it's even more exciting to see what the picture could be and what it might be in terms of tourism products. And I'm thinking more about Waipa. So I don't know if you've got any examples of your product development, your experience, or things that we should be focusing on to create a bigger tourism picture for the Waipa area.
Yeah, thank you. Some of the development is developing itineraries and travel routes to showcase. And we're always there to support anyone who's looking at developing their own as well, of course. I think for Waipa, your biggest opportunity is Te Arawai Journeys. That product that was developed, the website is phenomenal. I think it's amazing, and you can tell from the engagement of our social media posts that the people think it is too. So I think that's one of the biggest opportunities for your district. I'd love to see it broader than just Waipa, but that's a different discussion. Does that help? I'm not.
Yeah, I think that helps. But Mount Prongia is a beautiful place. The walks through there, Māori tourism, food. There's just so many opportunities out there. We just need someone to point us in the right direction so we can make it happen.
Yeah, look, and we're more than happy to point anyone in the right direction. And sometimes we are not the operator. We need someone to invest in developing those opportunities. Food, the food tourism strategy that we did 3 years ago, 4 years ago, certainly pointed and highlighted that our region is dairies and berries are a lot in here in the Waipa. So that's a real opportunity. We focus on that a lot in that season. The cultural, look, we've been talking about cultural experiences for some time. We can't develop those. We need Mana Whenua to develop those. So we're happy to guide and support as much as possible.
Thanks for that.
Oh,
Right.
sorry, can I just mention,
Yep.
sorry, Pirongia walks, we do normally have that a lot on our website and showcased a lot. We've put that on pause at the moment in consideration of what's going on out there.
Wise. Right, can we just, the last two questions are Claire and Roger, but we're now into the red, so just everything nice and succinct, thank you.
Yeah, I know, just a big shout out for the work you're doing with Jetstar because of the new link. I think that's fantastic work. Well, yeah, keep it up. Thanks, Claire.
Hi,
Hey.
and mine's about a future opportunity. And when you talk about Te Arawai as an opportunity, another one, of course, that's coming up, and I just need confirmation that you're already talking with them, and that's the New Zealand Sports Hall of Fame, which is going to be another fabulous opportunity to attract people into. What kind of pre-planning have you got going on for that release?
So we have had staff go and spend time with them to learn what's happening, and we're right there ready for when announcements can be made, we can start sharing. We've got teams in trade, travel trade, meetings and conferences now, exhibitions, and all of that new product is certainly being talked about.
That's really good to hear, actually. Really perfect. So thank you, Nicola. Thank you, Sally, for the introduction. And I won't read every word of it, but the report titled Hamilton and Waikato Tourism 6-monthly report from the 1st of July to the 31st of December 2025. Have a mover and a seconder. Thank you, Roger. And thank you. I think Pip just won that race. All those in favour? Against? Carries. Thank you so much for your time and wonderful reports. Thank you. Right, we'll bring up the wonderful Joe Greed. So page 76 through to 128. And this is the elected member allowance and expenses policy. Sorry, Joe, go. Sorry.
Thank you. You've had a long afternoon, so just briefly, this report is purpose of it is to revoke your current elected members' allowances and recovery of expenses policy and replace it with a new revised one, which has a different structure and also has a number of other changes from your previous rules, which we've listed there in section 4 of your report. So I'm just going to leave it there and see if anyone has got any questions.
Thank you, Joe. Well, I'll start with the first question through Councillor Gower, who's actually just left. So on page 110, if we can turn to that, and item 51. And so the question is, other councils only pay for the mayor and CE, not the deputy mayor. How much travelling is done with solo deputy mayor, mayor and CE? Can take one extra guest each into the lounge. Oh, so he's talking about Koru Club, sorry. The price now for Koru Club is quite high per year, and I'm thinking about not renewing. Oh, right, so that's out of it. So look, the question is basically, the mayor and the CE get Koru Club, and in this paper here, so does the deputy mayor. Hey, I'll start off with it. You can add to it. This is a discussion that I've had with someone somewhere, and the rationale I personally gave for this, it's up to the floor to decide on this, is often we will travel together, okay? Conferences will either finish late or finish early. Traffic and all the rest of it. To change an airfare is actually quite expensive to get someone home. And so if you get different airfares back to the airport, and the last taxi ride I got was $63 back to Cambridge, but that was about 6 years ago, so I'm not sure what the cost is now. It can get cost prohibitive pretty quickly. So Yeah, so that is the rationale, I guess, that we try and get people on the same planes, but like the last trip to Wellington we did, our flight was at 7 o'clock, there was one at 4:30, and we took it. So that was a rationale. There was a rationale there. But hey, open to further comments around that, or Joe, anything from you? No. Right, yeah.
So just on that, I thought that the question that councillor Gower was asking was just about the Koru Club, not about the flexi fares. But I think what you're saying is that it's not always possible for both of the mayor and the deputy mayor to travel back on the same flight. So it's important to have that flexibility and allow them to be able to use the Koru Club facilities.
Yeah, and look, yeah. And while you're waiting for a flight, it's a bit like, the downtime of my job is driving in a car across the swamp when you can't get connectivity. You're always wanting to be working every minute you're trying to make use of. So in those Koru clubs, I've only been in there twice because we've only been on 2 trips, but the work has not stopped. Not only that, the networking with other mayors, deputy mayors and councillors, etc., and CEs, etc., in those rooms, all the corridors happening. So a conference doesn't, or whatever we go to, doesn't start on the day at 9 o'clock in the morning. It starts the moment you get out of your car and you get into the airport, really. So that's just a rationale for it.
I was going to ask about the insurance, Joe. So that's on page 78 of the summary. It's under travel bookings. It says a new section on travel insurance has been included, which reflects current practice that travel insurance is only arranged for international travel. So what I understood that there was some kind of blanket travel insurance arrangement if like bad weather prevents you from flying back home, like it did for me from Queenstown. So I had to stay another night in Queenstown, and that was able to be claimed through travel insurance. So it looks like no domestic travel is covered with travel insurance anymore. And so, yeah.
I think, Councillor Clare, it's a separate conversation from the fact that you had a valid business reason to book your accommodation and claim it back out of your control. So that would be approved. We would then deal on the other side of it, looking at insurance, right, where we have it.
All
Yeah.
right, so we just
So,
don't have to worry
yeah,
about
so I
that.
think
Yeah.
as per the policy, if there's a business reason, in the case you mentioned, you would be reimbursed.
You're saying it doesn't really need to be in this policy. Yeah, cool. Thanks.
Yeah, it's an internal operation matter that we've got to weigh the cost versus benefit of insurance for domestic.
Any other questions for staff? All right. Thank you, Joe. All right. So I'll call for a mover and a seconder. Thank you, Claire. I think we've got Dean there. All right. Any other debate or conversation among elected members on this? No, there've been none. So I'll put it to the vote. All those in favour? Against? Carried. Right, thank you very much, team. Right, we are now on to, so Tommaso, I invite you up, and page 129 to 265, and it's the council controlled organisations, draft 2026-2027 statement of intent, and 6 monthly reports to the 31st of December 25, and we've got a few speakers that will come up also. Now, I've got here, have we got an external person, Andrew?
He's online.
Yeah, Andrew
From
Bickle
LG.
from the LGFA will be dialing in later, but I believe our first.
He's there now. Perfect. Kia ora and welcome, Andrew.
Thank you.
And we look, and later down the trip, we've got Calvin French and we've got Mark, Morgan and Scott from Waikato Regional Airport Limited. So welcome to you all. Tommaso.
Thank you. Sorry. I assume the report is has been read, so I would just like to think. Sorry, excuse me. I'm a little bit shy, to be honest. Thank you. Yes, so the statement of intent for next year, as well as the 6-month report from July to December 25 are prepared, and for all the different CCOs owned by the council. And we've got here the representatives from the different organizations to provide us with an update.
Right, so are we best to invite you folks up, I think, to the table? You happy with that? Oh, right, so we'll start off with Mark and,
Andrew, time pressure.
No.
no, you're right, Andrew. So maybe we'll start with Mark and Scott. Yep.
Thanks, Tommy.
Andrew, we'll have you on at 3 o'clock as per, or close to. You're next up.
Thank you.
These guys come to the table, someone's trying to get this up, but you should probably see the front page of the Michael Times. There, but there's only gentleman who's amongst us. There you go, Mark. Is it on track for you?
Thanks, Steph. Good afternoon. Thanks, Mayor and Council. And firstly, congratulations. I think it's the first time we've presented formally to you since your elections late last year. Further on from Steph's comment, if you haven't seen it, it was publicly announced today by Minister Jones that we have been successful in securing a $6.5 million regional infrastructure fund to extend the runway and also complete some apron works. It's about an extension of about 255 metres. So the Crown is contributing $6.5 million and we're contributing $3.3 million. So it's just under a $10 million project. So we're delighted to have achieved that. What I would say, this has been an 18-month program, and Steph has been very instrumental along with our board and myself and Ben to actually get this across the line with Kanoa. And they see the real value of having Hamilton as an alternate, providing that upper North Island, that New Zealand resilience piece. So we would hope we've got some work to do with Kanoa around the details around the lease, the loan agreement, which will complete over the next month or so. And there are a couple of conditions that we will need to meet that will ultimately see that loan move from a concessionary loan to a suspensory loan. So really good news. What I would sort of add to that is you've got our half-year accounts. It's been a solid half year. As you'll see, and Scott will take you through the financials in a moment. But the trading performance of the group was ahead of our budget and forecast. We've had strong passenger volumes and significant capital investment in that 6-month period, 12 million alone, with another probably 20-odd million in this current calendar year. So, and I guess it sort of links into transitioning our business from this diversification strategy to a growth strategy. And look, the economy has been solid, it's been improving, but of course we've now got a fuel crisis and that's a major impact on the aviation industry, on the airlines, and it's too soon to actually understand how that will impact airports, but we know there could well be some concern for travel, either in terms of the cost of travel or people's decisions not to travel at the moment. But at the moment, it's progressing pretty well.
Okay, good afternoon, everyone. We did tend to have a presentation deck available.
I just realised,
which we might just see if there's a chance it can be brought up.
Got a little.
Oh, excellent.
Dongle there.
Yeah, perfect.
Good, Scott. Lucky you're onto it.
Little clicker doesn't like me very much.
Yeah.
Oh, there he is.
One back.
Yes. There you go. So this is a excuse the pun, a runway, just a financial outlook. So you have the half-year accounts in front of you. And if you've read the P&L, you'll get to see a $12,000 profit for the half year, which is not obviously a stellar number in its own right, but I think it's important in the context of the journey the airport's been on over the past few years, that we have been heavily reliant on property through reasonably challenging economic times. There's of course a hotel, was an MIQ. There's been a significant amount of land sale activity. See, land sales are finite resource to sell. That capital has been reinvested in so the assets we've got today, international airport infrastructure, other income generating property assets. So we are moving from that selling land, which of course has created some very strong profits in the strong property market the past few years. We're back to being an airport. So this half year result has no land sale activity, it has no valuation gains. It's good old fashioned mahi trading profit, money in the bank sort of stuff. So it's, look at this break even result. That's significantly ahead of where we expected. There was some sacrifices made with the enabling investment to get Jetstar back into the region. There's a lot of startup operating costs. There's additional operating costs of running a full terminal. The border agencies, there's obviously depreciation and interest from funding it. So we didn't actually expect to be returning a profit from trading operations in 2027 or 2028. So obviously really excited that not only have we had Jetstar bring in an international service, we've had Air New Zealand, additional capacity through Jets, we've had Jetstar domestic, and that's all seen us return to, albeit break even, but increasing through the second half of the year to profit a year early. It's the first time since 2019 that the airport in its own right as an airport has been profitable. So I think that again, sort of significant steps we've made in the past year. But we now expect to see that to continue. That land sales sort of strategy around property is now very focused on holding assets. So, and we'll talk about Precinct North in a minute, but those assets we hold have significant rent rolls with them and generate a significant amount of income. So I think it's reasonable over the next couple of years, we'll see at least sort of 4 million a year in new revenues coming through. And sort of profits getting up without significant or really any land sale activity to sort of 7 million. And your share of an investment that was worth probably 100 million a few years ago being worth upwards of 300 million. Just the next slide, sort of appreciate there's a number of percentages around growth and things talked about. Unhelpfully, if maths isn't your strong point, the airlines didn't nicely start all their services on the 1st of July. They've been started through the year. So we have been the past few years pretty static at around 360,000, 370,000 domestic travellers. We've seen now for part of a full year of international services and sort of part of the year of different airlines doing domestic services, got us to about a 39% growth. But if you take the schedule we've got today, we've got two services by Jetstar, one daily across the Tasman, one to Christchurch, the fully New Zealand schedule. That takes us to about 70% year-on-year growth if you sort of annualise those numbers. That's sort of significant and probably what many of us suspected, the opportunity for the region and our airport to capture with people that were leaking sort of, and particularly driving to Auckland. So yeah, significant step forward. Obviously that the airport realises that through not only landing charges, but there's now more sort of stakeholders at the airport. There's border agencies that pay leases. There's also things through cafe and car parking and things like that. So it's not, the revenue generation isn't entirely reliant on airlines. And thought to make that point, obviously, airline pricing has been something that's talked about in the media, and important to note that as we talk about our property strategy, that's enabled us to buffer sort of large cost shots and things for airlines as well. More in the recent times, a lot of narrative around airline schedules, so and particularly reductions with fuel prices. Look, Hamilton has had a relatively minimal impact so far. There's a few Wellington off-peak flights, I think sort of about 3 or 4 weeks through to mid-May that have been suspended, able to reaccommodate people on the same day, which is important. So we're not actually losing huge amounts of capacity that mean we're stopping people from being able to fly out of the region or indeed get to the region as well. At this stage, Jetstar happy to maintain their current schedule as well. I've announced today some reductions around the network, but Hamilton's not been impacted yet. So forward indicators, the car park's still pretty full. We're still seeing people sort of coming through. Indications of forward bookings are strong, and actually pleasingly airfares haven't gone up significantly either. So in context of fuel increases. This is just probably the last slide you'll have for me, and I'll hand back to Mark. So look, as I mentioned earlier, you annualise our passenger growth, it's about sort of 70%. That gets us to about sort of somewhere about 600,000. We've obviously got aspirations to grow further. There's some blue and green lines on the map we're already flying, and there's some yellow lines there, which there's no secrets to let out the bag or anything today, unfortunately. I think those are destinations that anecdotally, I think we'd all agree we'd all love to fly to. We've probably all flown to. So they're the obvious opportunities. There's lots of traffic, trans-Tasman traffic or inter-island traffic up to the Pacific. We've invested heavily. We've brought on a new General Manager of Aeronautical Growth and Business Development with the view of actually really understanding our catchment. There's a lot of numbers flying around, getting some real rich data around people's travel behaviour out of the region and travel behaviour into the region as well, obviously to bring tourism into the region. So those are obvious opportunities anecdotally. I guess the next step is to actually validate those, verify those, and work with airlines over the next sort of couple of years or so. And I'll hand you back to Mark.
Just briefly here, sorry, I should grab that. Just briefly here, I think you remember previously that we have a designation or a multiple, 4 or 5 designations centred around the extension of the runway. Those designations are due to lapse later this year. As you're well aware, we're working hard to make application, obviously through Waipa, and though that process is well underway, the council have appointed an independent commissioner and planner. We'll start to work. We'll have a draft application ready towards the end of next month, and we'll be working with the planner with the intention of lodging our application about June of this year, and having that heard prior to the lapse date in October, and obviously a decision. The announcement today, I think, from the government will certainly help the veracity of that application that we'll be making. And we've been in touch with the landowners, principal landowners that are impacted by the designation, and we've had strong support from those landowners. So I think we'll be well placed to engage with your independent commissioner and planner during the course of this year. Just very briefly, some of you have been out on the tour, so I won't focus on this, but those of you that haven't seen the airport recently, this is Precinct North, the 18 hectares of land we're opening up, stage 1 and stage 2. With the key tenant on stage 1 of Asmus, who will move in. The building's all but finished. They will take occupancy during April, and officially their lease commences in May. So we're very excited about that. And whilst there's some challenge in the economy, we have a current negotiation with another design build that has a heads of agreement that I hope that we'll sign this week. So there is some general and genuine inquiry still to keep that process moving well. And as I've mentioned previously, the rent roll of the Asmus build funds the bill, but it also funds the stage 1, stage 2 development as well. So we're in respect of the interest that costs on that development. So just last slide, I'm conscious of your time. So look, the wrap up really, I mean, today's news is pretty exciting for us. So I think it just continues to support the focus and direction of the airport. We expect our full year financial results to be ahead of budget, and we still believe that given the uncertain environment we're facing. Key projects on track. As I say, there are tens of millions of investment that we're making over the next 12 to 18 months. Scott's mentioned the jet service, but we're delighted with that. We are continuing to engage with the airlines, and in fact, we're in Melbourne next week to catch up with Jetstar to have a strategy session with them. So I think it's just a reinforcement that we're keeping this moving as strongly as we possibly can. So look, I don't think there's any other comments here that I need to make other than we remain, it's part of our 10-year strategy taking us through to the mid-2030s. We remain on track, and we're happy to obviously answer any questions, Mayor, if you'd like.
Sure, Mark. Hey, and just again, congratulations on that Regional Infrastructure Fund It's a big ticket item which will have long-term benefits. So to be fair, we've got 1 hour set down for all three presentations. We have to be fair on everyone. So we'll go for about sort of 6 or 7 minutes on questions. So we've got Pip and then Roger. And Shane, sorry.
Congratulations, Mark and the team, and sort of pulling together great business. Wonderful building assets, and obviously you want to reinvest all the returns back in your business, rather than sitting in our balance sheet as a sort of a wonderful asset. But we too, like all good shareholders, like to think about when dividends might flow. So my question, very directly, is at what point in time will the shareholders like Waipa District Council be able to receive a dividend yield rather than a line in our balance sheet to say we've got an increasingly valuable asset?
I'd preface any comment about dividends that it is responsibility of the board and not of management. So I just have to preface those comments. And I'd say, look, the board. I mean, obviously the board are tasked with. We have a dividend policy that the shareholders approved in the last couple of years, the updated one, and the board consider every year based on the requirements of the business and obviously the interests of the shareholders. So look, we set a strategy a number of years ago, certainly before this current council, around the dividends and the dividend streams. And I guess today's announcement's a great example. We are investing, it's debt funded, the 3.5 million that we're now going to contribute with the Crown to build this set of infrastructures, I suppose is a great example of the decisions that the company has to make around the investment of both the aeronautical infrastructure and the property sort of initiatives. I guess all I can suggest is that the shareholders should, if they're concerned with the dividend policy or the direction, then it's really a conversation to have as shareholders with the board. But the board are mindful, and that's why we have made representative dividends, I guess, 500,000 last year. And I think the board are mindful of some dividends, but also the strong requirement to invest in the business at the moment.
Thank you for that. So Roger.
Yes, thank you. And I really enjoyed the presentation that we had out at the Jet Park, which you gave a lot more information, and it was really useful to have that information. I think this seasonal result that they're showing, a 70% increase, is absolutely tremendous. And that does definitely have an impact in Waipa in terms of increased visitor flow. And as a very, very small operator, I've had evidence of that. Really interested in that extension of the runway. You mentioned that it was supported in terms of your lobby for resilience in terms of the New Zealand network, but what is the capability enhancement that it's bringing to the airport?
A couple of points I'd make, and firstly, you've triggered back to the previous question, and what I would say that we shouldn't overlook as shareholders and as councils, that each new jet service introduces about $45 million of economic benefit to the region. So there is also that at play as well. In terms of the extension, look, it's designed as a resilience piece at this point. So that extended runway will allow Hamilton to be used as an alternate for the airlines in the case of weather events in Auckland in particular, but it could be weather events in Christchurch as well. That allows the alternate of Hamilton. So that's the principle of it. It does allow, the extension allows us to be an alternate for wide-bodied jets as well as narrow-body jets. Now, again, not for scheduled services, because there is a huge amount of additional infrastructure, including runway strengthening, required for day-to-day scheduled wide-body jet services, but it does allow us to accommodate ad hoc in that sense.
Yeah.
Thank you for that. Shane?
Really enjoyed the tour the other day, and I just want to acknowledge the great job that you guys have done in terms of where the airport is right now. And you used the word transitional. I think that's a very good word to use. I would encourage you to think about, if you're in a transitional phase, who are the best shareholders? And I would say we are lousy shareholders. One, we've got no money. Two, we've got no expertise in property or running an airport. So I just want you to take that on board. Is this the time to start thinking about your who the shareholders are in the best way? The other point is, and my colleague Pip has mentioned it, I think there's going to be more and more focus on getting those dividends to a commercial type dividend for local government. So, we're not going to be the source of money now, and we're not going to accept not getting any good, strong dividends. So I guess that I just want to deliver a message, and I know it's your board's decision, but I'm hoping that we'll have a process that your board will hear very loudly and clearly that transition is a good word, and it's maybe time.
Thanks for that. Just one final question, and it's really for anyone looking online or looking back at this. Can you just tell us the difference as we go from a concessional to a suspense loan, and what that really means in practical sense, if you could answer that?
I probably should have let the finance man in the room answer, but essentially the concessionary loan is a loan, and it attracts interest, and it's repayable, both principal and capital. If and when the Crown agrees to suspend the loan, then it is not repayable, either the capital or the interest, by the airport company.
All right.
And sorry, Mayor, I should say, and that's based principally on two key conditions that the ministers have imposed on the loan details. But I prefer to share those private rather than a public forum.
No, look, thanks for that, and answering those questions succinctly again. So thank you, Scott. Thank you, Mark. Yeah, and you're welcome to stay, but you're welcome also to go. So thank you for your time. And again, thanks for that tour a couple of weeks ago. It was fantastic. All right, we're now going to head to the LGFA presentation via Andrew, and we're on page 144, LGFA presentation. So
thank you. Yeah, thank you for the opportunity to present to you today. Sorry I couldn't be with you in person. I'm in Christchurch at a Tai2R Finance conference, so I'll just try and share my presentation here. This will work. Apologies, I can share it in Teams. I'm just not sure I can share it in Zoom. Anyway, have you got a copy of the presentation in front of you?
we have a report, not a sort of a PowerPoint or a, oh, sorry. Sorry, I was about to share it here.
Yeah.
You just tell us, Andrew, when you need us to change the page.
Okay. Yep. So page 2, I'll go through a very quick presentation for you, and then leave time for sort of questions. In terms of the overview of LGFA, we now have 77 council members out of 78 and 8 CCTOs who we lend to, and we're about to start lending to water entities, including Waikato Waters, fairly shortly. And of those 77 member councils, 74 are guarantors of LGFA. I'll come to that. In terms of the credit rating, we just had our AAA rating affirmed by Fitch last week, but we did get news from Fitch that they've put the New Zealand sovereign rating, which is the same as LGFA's rating, on negative outlook. So they are concerned about the New Zealand government's fiscal position. Doesn't come as a total surprise. But we also have some councils that Fitch rate AA+. So we would expect if the New Zealand sovereign rating is downgraded by Fitch, then that will flow through to both LGFA and councils because non-government entities can't be rated higher than the government. So that's something to keep an eye on. This is just a very quick summary of our financials. So I will touch briefly on our half-year report and our SOI, but you can see the shareholder equity is continuing to build, and that we try to do that in line with the growth in our total assets. And our total assets largely reflect council lending. So at the moment we have $24 billion of loans to councils. So page 5. Firstly, on the half-year, both the half-year report and the SOI, there's nothing of surprise in those. In terms of the half-year report, our operating profit was 16.4 million. That's ahead of our forecast, and it's also a 90% increase on last year's 6-monthly profit. The reason it's higher is we increased our lending margins by 5 basis points last year, and we did that to ensure we retained our AAA credit rating with S&P. And the reason we need to build more equity is to reflect increasing risk in the sector. So we saw a large number of councils downgraded in the last year, particularly by Standard & Poor's, reflecting greater levels of debt, and also the new lending, which is about to start to water entities, is going to increase risk, given that water entities will be more highly leveraged than what councils have been historically. In terms of the draft SOI, again, there's no change in the strategic priorities. The one thing that is changing is the implementation of lending to water CCOs. And so we have potentially five new water CCOs that we'll start lending to in July this year, and another 13 for 2027. But again, on page 5, you can see our levels of issuance, and they're going to be quite constant, although it is quite hard to forecast given we don't know exactly what the water entities are going to be borrowing for their CapEx programs. Page 6, just to give you an overview on LGFA's capital, given that Waipa is a guarantor of LGFA. So we have at December 25, 138 million of equity that's been accumulated in the business, 20 million of uncalled capital, and then we have the borrower notes that the board could decide to convert into equity if it ever needed to do. So that gives us close to 900 million of equity before we would have to call under the guarantee. So the council's guarantee of LGFA means that the trustee could call on the council if LGFA was at risk of defaulting. What you're not guaranteeing is the debt of other councils, so you're guaranteeing LGFA's financial obligations. So as at June 25, your share of the guarantee was 0.95%, and that means for every $100 million that the trustee called, Waipa will be asked to contribute 950,000. If a council defaulted, it wouldn't necessarily be a concern from LGFA because we have plenty of liquidity, over $4 billion at December 25 that we could use. And we also have a $3 billion facility with the Crown, which we've never drawn down upon. But again, that's available us to manage any liquidity issues. So when we lend to a council, what we have is security over rates. So if a council defaulted, we could put in a receiver, and the receiver would then impose a special rate and recover that money over a period of years, whatever was deemed reasonable to repay the loans. Local water done well, I've touched on. So again, we're about to, our legal negotiations have been a bit more complex, but we're about to sign, or LGFA directors are about to sign the legal accession with both Selwyn Waters and Waikato Waters in the next week. So that's really exciting for us being able to, after so much talk, finally lend. But happy to answer any questions on the water CCOs. So yeah, page 8. Again, I just wanted to touch on the security when we lend to Waikato Waters. So there's a requirement from LGFA member councils when we lend to a CCO, we can only do so with a guarantee from the shareholder councils. So that's what we have got from the 6 councils that form Waikato Waters. They're all providing a guarantee to Waikato Waters in respect of LGFA's debt that is joint and several. But LGFA does not have any discretion not to do that, because that's something that's being imposed on us by council members. So we cannot lend to a water CCO if it doesn't have a guarantee from its parent shareholders. What would happen if there was a breach of covenants? What that would trigger is a 30-day negotiation period with the water entities and with the shareholder councils. But to give you a flavour of what might be decided on, is probably the most likely thing was we'd agree to a revised financial plan that we thought got the water entity back on track. We could also potentially ask for additional equity to be imposed, but we also have security over water charges. So if the water entity defaulted, we could choose to exercise the guarantee on water charges. And it's most likely we would do that before we called on the guarantee from councils, because if we did that, we would cause stress to the councils who are our members. So that would be a last resort option. So that security over water charges is something that is really important for us. Page 9, just wanted to touch on the bespoke covenant arrangement we have with Waipa. So we agreed, the LGFA board approved this in February 2025, which allowed Waipa to borrow up to 350% of net debt to revenue versus its previous limit of 280%. This bespoke covenant is available for high growth councils, and to date we've approved 2, which is Waipa and Tauranga District Council. When you signed up to that, there were some conditions that you agreed to. So the firstly is you provide us with monthly reporting, and just want to acknowledge Yolanda for all the work she does with that. We have a really good working relationship with her, and she answers any questions we have in respect of your financial performance. So you need to forecast a net debt to revenue outcome of less than 330%. So we're not saying the actual outcome has to be below 330%, but when you're doing your forecast, you need to maintain that 20% headroom versus the 350% limit. You need to forecast a balanced budget outcome of at least 100%, and that applies from the 2028-29 financial year. So again, based on your LTP, we provided you with a number of years to transition back to a balanced budget position. But that's not only is that a requirement that you need to comply with, but that's something I think with rates capping coming in, councils retaining a balanced budget position is going to be really important, because borrowing for operating purposes, when you don't have the ability to increase rates like you have in the past, is going to be challenging. You have to inform LGFA of any non-subsidised NZTA roading projects that exceed 500,000. And there's also an agreement that we will review the covenant if your council water debt transitions to a CCO. So that is something that is going to occur in July. So we're not saying we're going to take that away. It's just we will sit down with you and work out what you need going forward. So we're still happy to provide a higher growth covenant, given you're a high growth council, if that is something you're going to need once you get all your water debt repaid. And lastly, just the global situation with interest rates. I just wanted to put this up. This is interest rates over the last 4 years. So this is page 10. The black line at the bottom is the 2-year bond. And when we look at the yellow line at the top, that's more reflective of longer term interest rates. That's the 2037 bond, so 11 years now. So you can see that shorter term interest rates have come down, and that reflects the lower OCR rate of 2.25% at the moment. And longer term interest rates have remained relatively stable over the last few years. So currently they're a little bit lower than they were a year ago, but not a lot. But the last couple of weeks, it has been very volatile. So we're getting 20 basis point movements, either up or down on a daily basis, depending what's happening geopolitically. So I'll finish there and happy to answer any questions.
Right, thanks, Andrew. Look, that report there supplemented and added greatly to the report that we've got in front of us. So very thorough. James, comments?
Sorry, Andy, it's James Graham here. Can I just confirm that that interest rate charge excludes the margin on it?
Yes, that's correct. So it doesn't. So you pay a 25 basis point margin on top of those, plus a 5-point credit margin. So your total cost over those interest rates shown is 0.3% or 30 basis points.
And higher for longer term borrowing, right?
No, it's the same. Oh, sorry. Yeah, that is for borrowing out past 1 year. For shorter term, it's slightly less than that.
Thanks very much, Andy. I just wanted to raise that because we've had Earl White here earlier today and he talked to this point. So really good for the double confirmation.
Yeah. One thing I maybe should have touched on is like half our funding is coming from offshore markets now, which we hedge back into New Zealand dollars. So our last issue we issued in the US at the end of last year. That was over 6 times oversubscribed. So there were investors wanting us to issue a lot more than what we did. So at the moment, the sector doesn't have a financing challenge. It's not hard to get the financing when we're AAA rated. The sector's challenge really revolves around affordability. So when you take on more and more debt to do infrastructure, obviously there's a cost to ratepayers through servicing that debt.
Right, thank you. We've got one question from Claire.
Yeah, thanks, Andrew. Great presentation. I'm asking about the environmental and social responsibility commitments that you're making. This is on page 146 of our agenda, because you're talking about enhance our insight into climate-related risks through council lending. You'll probably know that we've just recently had some climate impacts in our district. And I'd just like to have a bit of a more detailed korero from you about what that's going to mean for individual councils. Is this more at a portfolio level that you are considering?
Yeah, I didn't put a slide on sustainability in the slide pack. Normally I would have that, but because you had the additional things like the bespoke covenants, I didn't include it. But we have two full-time resources on sustainability, Nick and Helen, who are doing a lot of work in terms of our lending products. We're also doing a lot of work on sector risks and analysis. So yeah, we're more than happy to come and do a fuller presentation on everything we're doing. But it's a directive from our shareholders to do more in this space. So as well as our independent members on our sustainability committee, our full board is very committed to supporting councils with their sustainability needs, but also from a lending perspective, overseeing the risks that exist in respect of climate change and resilience. Yeah.
Right, thanks. So look, I'm going to end questions there. So look, yeah, Andrew, hey, thank you very much for that report. Maybe if there are any questions, we can get them through James if there was any more. What we're going to do, because I just want to make sure that these 20-minute increments, we're sort of nice and fully focused. We are going to take exactly a 2-minute and 10-second break, okay? And then we're back and we're going to start if you're in the room or not. Thank you.
Thank you.
All right, thank you, folks, and we're pretty much stuck to time there. So look, our last of these presentations for the day is from CoLab, and we welcome Kelvin French to take us through, and then we can have some questions at the end of it. So over to you, Kelvin. Welcome, kia ora. Page 137.
Push that on. Thank you. Kia ora koutou. Thanks heaps for the opportunity to be here this afternoon. Look, I am going to be brief. I wanted to do two things today. First, quickly remind you of what CoLab exists to do. And secondly, talk you through the draft statement of intent that's included in your meeting pack. The short version is that CoLab is delivering real value for Waipa today, and the draft statement of intent is about scaling what's working now, but doing that in a disciplined way. At its core, CoLab exists to turn collaboration into practical outcomes for councils. Our vision is that collaboration through CoLab maximises community wellbeing, and our purpose is very simple: enabling councils to identify and realise benefit from shared opportunities. And we do that in three ways. First, we act as an ideas laboratory, working with councils to investigate and develop opportunities to work together. Secondly, we deliver shared services to councils. And third, we use joint procurements to lower costs and improve outcomes for councils. And the most notable of those are the professional services panel arrangement that's in place and the insurance collective. So increasingly over the last few years, we've seen that work happening with smaller groups of councils. So we're less inclined to everyone needs to be in the tent to move forward, but identify those who are very keen to move in a particular way and work with them to move at pace. Our relationship with Waipa is significant, and actually the key point on this slide is not the list. It's the depth of the relationship that the list represents. Waipa is certainly one of our more engaging councils across a wide range of services and involvement in collaborative initiatives. And in addition to those services that you receive, you benefit, as I mentioned earlier, from joint procurements and investigating opportunities. Steph's role on the CoLab board strengthens the relationship further. She's awesome, just quietly, and ensures that Waipa's perspective is very well represented. What was that, Steph? I'm not just saying that.
Thank you.
Look, in simple terms, last year CoLab generated around about 1.8 million of quantified value for Waipa. And that's before you account for the harder to measure collaborative benefits. So that 1.6 includes approximately, or 1.8 I should say, includes approximately 1.6 in procurement savings and contracts. And I referenced PSP and the insurance earlier, and then about a couple of $100,000 in efficiency gains. And that, as I say, is before we get into the harder to measure benefits like shared capability, resilience and reducing duplication, and quite frankly, just your staff talking to their counterparts and learning from counterparts and other councils. I know that there's a massive amount of value out of the working parties. This slide here is the regional benefits of collaboration. It's up there mainly to show that what Waipa is experiencing is not an outlier. So these are the benefits that we've measured across our shareholder group, and the pattern is consistent. The reality is that collaboration, when it is done well, delivers tangible value. That value in a readily quantifiable way is sitting at about $10 million per annum. So the focus for us is really about making sure that those benefits are real, measurable, and of course sustainable over time. If I turn now to CoLab's draft statement of intent, as you know, the document's out for consultation at the moment with councils who have until 1st of May to provide us with feedback, which will then get taken on board and factored into what the final document looks like by the end of June. That SOI is setting out our plan that we intend to deliver over the coming year, how we're going to measure our performance, and of course financial forecasts for the coming 3 years. The key point is that there's actually nothing radical in the SOI. This year we've been quite deliberate in keeping it consistent with the 3-year strategy. We are moving into the third year of our third and final year of that strategy. A key part of that strategy is to grow the scale of our shared services, and what's different is not what we're here to do, but the pace and scale at which we're doing it. So what we've seen over the past couple of years is that councils have increasingly asked us to move more from concept to delivery and to do that together, and that's translated to a stronger uptake in some of our shared services, earlier than planned growth and greater confidence and collaboration. So as a result of all of that, at the halfway point of the strategy, we've delivered 16 of a planned 24 new instances of services. And based on that momentum, we've revised that target for the 3 years upwards to 28 by the end of June next year. Look, it is draft. As you guys well know, there is an awful lot going on in the reform space, and I fully expect that shareholder expectations will crystallise over the coming months, and we need to be flexible enough to respond to that. So I do see some finessing and refinement of the SOI as we establish what the role CoLab will play with respect to that reform is. The point is that we want to be a reliable backbone for whatever collaboration takes place. From a financial perspective, I touched on it earlier, the SOI is around disciplined conservative growth. We are forecasting revenue to increase in the coming year. We've certainly seen that in the current year with the introduction of REMU and CoLab Building Services. Wherever possible, if we're increasing our service revenue and making a margin from that, we will look to reduce member charges that councils pay to bring the cost down for member councils. So look, while expenditure is increasing as we position ourselves for growth, we do remain, I think, a very lean organisation, and we've got tight cost controls in place. Over time, our intent is to invest where services create more, where that reinvestment in services can create more value for councils and further reduce reliance on member charges. And I know management in the PAC reported aspiration to reduce, basically become self-reliant, right? And it's certainly an aspiration of mine. We have made no assumptions about the central government reforms and the role that we play. So it's very much status quo in terms of what you're seeing here. That's it. I'm very happy to take questions or get any immediate thoughts. Thank you, Mayor.
Thank you, Kelvin, for that. I just want to make it is a question actually. It's based on, I think, the first mayoral forum I went to, which must have been last year at some point in time. Well, it was after October. And I sort of brought up, because of CoLab, around fuel bills. Now, it's not because fuel's gone through the roof now that I'm bringing it to you, but there was a lot of interest instantly in that room by the CEOs and the mayors. And there were some quick numbers done on the spot almost by some of the councils. But there was a real interest in exploring that and just doing a bit of work on that to get a collective approach and see if there's any savings. So I'll just leave that with you, but I might,
Thank you, Mayor.
yeah, I might try and formally put that on the next mayoral forum agenda. Yep. So just a heads up. Right, Claire.
Yeah, thanks, Kelvin. Yeah, congratulations on a great report.
Thank you.
Just got two questions. One was about, you know, the reforms and the regional collaboration. Like, I was just wondering if you did have any insights in how CoLab might have a role in that. And my second question was just about AI and how you might be using it in some of your work streams, or how you might like to be using it.
Yep, thank you, Councillor. So in terms of the responding to central government reform, that has been discussed certainly at a CE level. Look, I think Waikato Water Done Well is a really good example of how CoLab can make council's life easy, right? We are very happy to be the administrative arm of pretty significant projects and support in other ways where mayors and councillors are keen for us to do so, right? But even that administrative support and being the contracting party for and managing funds coming in and out, I think is certainly helpful. And then your second point, remind me, sorry, councillor.
AI and how you might be using it in your work streams or how you'd like to be using it.
Right. Great timing. I'm a big fan of AI, I must admit. I use it myself on a daily basis. Look, we have engaged PwC and they've been running a few workshops with us. So we've got a pilot group on Monday. No, actually yesterday we were building agents for the first time. So look, we're going to get to a point where my expectation is that staff will be using it, to be honest. And I have intentions to ask them that when I'm looking at stuff, right? So it's just going to become a matter of course. And I can absolutely see that filtering through into the services that we're offering and certainly some of the opportunities that we're investigating. So the building consent checking assistant, which is a pretty significant project, something quite different from what we've done, but it's obviously AI centric. So yeah, it's happening.
Yeah. Cool. Thank you.
Kelvin, I just love this whole concept of people working together and ideas and etc. And I'm really encouraged by the results that Waipa has received from this relationship. So that's really great. I guess my question is about what constraints do you have to even do more faster and get bigger returns? Is there any constraints? Is it money? Is it skill, staff? Is there anything we can do to make this a bigger and better thing, delivering more returns?
Oh gosh, look, it probably does come down to money. I mean, everything costs, right? The trick is that we get a return on that investment. We, as a company, we're a far cry from what we were when I joined in 2018, and that's not down to me, that's down to the foresight of the CEs to actually transform the operating model of CoLab. Yes, I'm keen to do more. We have a reasonably significant services team now, right? So we total about 55 staff. And that's predominantly in the services space, but our opportunity development team is pretty small still. So there is only so much time and dollars that allow us to go at the pace that we go at, right? The trick is to make sure that we spend that money wisely.
Right, thank you for that, Kelvin. Oh, James, sorry.
Hey, I know we're running a bit short of time, but I just want to congratulate Kelvin. I've known Kelvin for a while, actually. When I was corporate GM at Bay of Plenty Regional Council, we were a member of BOPLAS, and I sat on the operating committee there, and we ended up as a shared procurement function because the councils wouldn't work together. And we realised a lot of procurement benefits, but nothing like this. And when I was CFO at Western Bay, I actually worked with Kelvin to join CoLab so that we could take part in not just the shared procurement, but these opportunities that is presented today. So I think you're underselling yourself a bit, mate, actually, to be honest. And so, I think great job. But I just wanted to provide the context, having been sat in two camps.
Kelvin, look, what a reply.
Thank you, James. That's very kind. Look, it comes down to fundamentally the mindset of the top dogs, right? The CEs and the people in this, other people in this room. And I have seen a material shift in mindset around working together in the time that I've been here. And I was approached, I got asked to get on a call with an MB official week before last, and quite unsolicited, they said that this group of councils are the best in the country at working together. You're getting a rep, keep it. It's awesome.
Yeah. Hey, and I can feel that. I've only been in the thing for 5 minutes, but you can feel the collegiality of the group. And that's obviously been built up over time because a lot of us are new, but if something is good and sustainable, the culture will transcend the people, and that's what I'm feeling. So I totally support that. And thanks, Steph, for your leadership in being a director on this, on CoLab also, because it is that sort of leadership that is giving the result for Waikato, and the positive result that it is. So thank you very much. Right, we are going to move A through I of this report by...
Sorry.
Yes.
But some of us might like changes to the suggested responses to the SOI.
Oh, right.
I'm thinking
Go
of
for
the regional airport. Yeah. Well, yeah, through you, Mayor, I'd like to suggest that we strengthen the wording for the regional airport letter about their dividend policy, and then Shane also made mention of looking for other partners or shareholders or something. Do you want to mention that as well? Well, just the dividend then. Yeah,
I mean, one is dividends, and then one is over time, the ability to sell your shares, but you can only sell your shares if there's someone to sell them to. So that's where that sort of question came from. And other airports have other shareholders that aren't councils.
I think the first one, there would probably be general agreements. The second one, we would need a decent discussion on that. Would that be fair?
Yeah, I'm not saying we should sell them. I'm just saying we should create an environment where we have that ability if we so desire.
Yeah, but I'm picking up on Claire's point that we actually want this written. So the bit about and the other thing is here, I guess, do we actually each understand the dividend policy that is currently set? No, so maybe before we do anything, we probably need to go back and actually have a look at that, which doesn't mean we can't in another F&C, financial corporate, put that forward. Would that be an acceptable way forward, that we should bring the policy to us and we have a little look at it?
I totally agree that we should understand the policy in detail before we are making suggestions on, or strong statements about changing it. Yeah, because I haven't seen it. Not yeah.
Okay, so we have before April to provide comments under the timeline. So
Is it June? Is it April?
statement of intent. Do you mind just talking to it, Yolanda? Yolanda, well, that's why I ask you, Claire. If I don't know the answer, or I'm 70% certain, in this case, I'm about 30.
So the CCOs have asked that we provide comment by early April. They then go back, they rework the SOI to take all our comments into account, and then they issue the final approved SOIs by the end of June.
The recommendation says it can be edited and changed. So if that's approved, would you know, Claire, if that gives us the opportunity to work on this offline by me consolidating the feedback and sending it out to councillors? Yeah.
Joe's just having a look at that.
Or do they have to be agreed?
257 has the text of the response to the SOI. I think it's the third to last paragraph.
Yeah.
About declaring a dividend. And that's just asking for a potential dividend to be indicated. But I think from what...
We've got the experts involved.
You need to agree at a high level what the changes will be. And we need to include
the
that
point
in
was made, it's the
recommendation, 'cause
board
otherwise
that
it doesn't
sets
say
the
who
dividend
makes those
policy, not
additions
the
and changes.
management.
It would be all outside of their control.
Okay.
So I can do a
Yeah,
list
so
of
it might-
high level
Yeah.
points.
I was-
If you tell me what you want.
Yeah. So we need to agree what those high level changes are. So the first one I'm hearing is a stronger message around dividend policy. And so I've heard understand the dividend policy. The councillor's interested in that. I've also heard the second thing is that we wish to receive a dividend.
Can I interrupt, please, Mike?
Yeah, sure.
I think we're in a bit of a pickle because I think that without having further explanation from Mark today, I think we need to get the chair of the board in. If you want to have a conversation about the dividend, I mean, you're well within your rights to express that desire. I'm wondering whether you need some context in which to express that with a little bit more detail than what you've heard today. And so we need to find a way where we create that space. If you're happy to accept the rest of the statement of intent, or sort of play on the 80-20 rule, and we'll figure a pathway forward in which we can have that conversation so we can finalise some input in the appropriate timeframe for the statement of intent feedback. Does that make sense?
Yeah, what we could do is a really good point, Steph, is we could include it as it is, strengthen the piece about the dividend expectation, but ask for them to present, have a session with the board, right? As part of this, and then that's the changes made, right? So what I'm hearing there, Joe, is strengthen the dividend expectations and for a meeting with the chair to talk through our expectations around dividends. So does that cover all?
Well, there'll be the opportunity to mention that.
Yeah, well, that could be it. We'll just attach it onto the bottom of that piece.
Yeah. So this is what I mean, though. With respect to the mayor, I think it's one of yours viewpoint has a view. We haven't discussed that as a collective and as an organisation, which is what I mean about getting context for us in terms of as being a co-owner of that CCO. So what I'm encouraging us to do is have the discussion and have the discussion with the chair of the board so that it can inform our view going forward.
We were just saying, on the leader, if we want to have a discussion, the discussion about dividend policy and shareholding, so that he knows what we want to talk about.
Well, I'm going to put that back to the table because that's personally not a view I share. So, yeah, I think we've gone a bridge beyond what the comfort of this table would be, but I'm standing to be corrected. But we almost might need to go around here.
You can raise it, absolutely. You
Yeah,
don't need
you
to.
can raise it.
Yeah, you can absolutely
Yeah.
raise it. But
I mean, it's $48 million, I think we're talking about.
Right, so any changes to the resolution? Any?
I think we need to, I just need to be clear on what they are.
Yeah. Sorry, folks online, we're just looking at any changes we do need to make to the resolutions here. And I think it might pay for us here to take the pressure off to actually adjourn until we get this sorted. So that we will do.
move to the next report. Yeah. June? June. Okay. What do you need, Johnny? No, I don't. You can forget about it.
All right, folks, we are back. So we're just about to get a change to one of the points. I'm not sure, it's just coming up on screen now, so we have a little look at that. All right, so C. All right, so it's under C. And the addition is subject to meeting with Waikato Regional Airport Limited Chair to inform further feedback on the draft statement of intent. And that keeps it nice and open. Happy with that? Keeps it nice and open.
Okay.
All right, so with that, now do we need to move the amendment for a start? No,
We haven't moved.
we haven't moved the rest of it
We
yet.
haven't moved.
Right, so now I will move A through I. No, that's fine. Yeah, we'll move A through, yeah, she's right here, see? We'll move A through I. Can we have a mover? Thank you, Dean. Thank you, Pip. All those in favour? Against? Carries. Well done, team.
Oh, hello.
All right, so, hey, we're just going to actually just do a formal, we're just going to do a little formal welcome of
Assume the chair, Tommy.
Tommaso.
It is, but we call him Tommy.
I know, but I want to hear it.
Multicultural.
I want to hear it
Because we're
pronounced.
very multicultural here.
I want to hear it pronounced correctly. So,
Yeah. So I do apologise. What? Because. Right, I just wanted to introduce Tommy. Tommy is our new Yolanda finance manager. Tommy's been here a couple of months now, and he's still here, so that's a good sign. I have introduced Tommy previously at the Risk and Assurance Committee. Of course, I forgot not everyone attends that, so thanks for the prompt, Steph. And so, yeah, welcome, Tommy, and it's good to have you here. Thank you.
yeah.
We do have Helen online.
Tommaso? That's correct. Well, Tommy, so just, it's Italian? All right, so you do have some yeah, you've got that. You got William over here in the corner. You got Joe here. All right, well done. All right, so now we're going to move into public excluded. So can I have someone move that, please? Thank you, Claire. Thank you, Dale Marie. All those in favour?